Okay, good morning, ladies and gentlemen. Thank you for being here so early on a Saturday morning. I know it's never nice to have to get out, and it's getting a little bit more difficult as it gets a little bit colder. But I hope that today is going to be a good day, and that at least you'll feel that when you walk out of here that you've learned something new and that it's been worthwhile. Okay, so my name is Tanya Hill. I am the coordinator of this program, so it's the first time that I see you. But you might have seen a couple of emails coming through from me. I'm the person who sends through the administrative details, and if you have any issues, I'm the person that you need to contact. So I hope that I get to know you all a little bit better during the year. This is my first lecture for the year with you, but I will be seeing you a few times during the year. Just to give you a little bit of background, I've been lecturing here at the university for the past 10 years. I've lectured on second year, third year honours. I'm currently lecturing on the second year module, which is similar to what we're doing on this course. I really enjoy it, and I always try and make things as simple and practical as possible. So that is really what I would like to try and do today. But if you have any questions, if you're unsure of something that I've explained, please ask me. We're here to learn, and if I haven't explained something or you're not sure about something, please just ask me so that I can try and make it a little bit simpler and clearer. Okay, so just a little bit of where we're going with today's lecture. So up until now, you've done tax in context, we've looked at gross income, we've looked at special inclusions, and we've looked at exempt income. So you looked at the whole income situation of a tax calculation. And then we started by looking at general deductions, the general deduction formula, as well as special deductions. Now, today's lecture is actually just an extension of the general deductions and special deductions. We're going to be looking at capital allowances and leases, which are really just special deductions. But we put them together because they are all similar in nature. Okay? And that nature that they have is that they are capital in nature. Okay, so all the transactions that we're dealing with today are transactions that are capital in nature. Right, so that's what we're going to do for most of today's lecture, is we're going to focus on capital allowances and then on leases. Okay, and then just the last part of today's lecture, we're going to start on capital gains tax, but a very, very brief introduction. In lecture 7, in our next lecture, we're going to finish capital gains tax. So today is just a very brief, quick intro, okay, which you need to be able to do your assignment, which is coming up. Okay, so some of you have asked, what is the assignment going to be based on? Well, the assignment, okay, you'll remember it would have been a test, but we've turned it into an assignment now, will be based on the work that you've done since the last test. So that will be you did up to special inclusion, so it will be exempt income, general deduction formula, special deductions, okay, including capital allowances and leases, and then the very, very brief bit that I do on CGT today. Okay, I will also post that information in the admin announcement that I send out this week again. But so what we do today will also be included in the assignment, and hopefully if after today's lecture it should be easy enough to do. Right. Okay, so let's jump into our lecture. We're doing capital allowances, and like I've said to you, it is actually just part of special deductions, so nothing has changed. Right, so this is where we're sitting at the moment. In lecture 6, we're doing capital allowances, and it is based in chapter 16 in your textbook. Let's try that again. Chapter 13 in your textbook. You'll see that to click up, we've loaded up an index of chapter 13, and in there we've indicated specifically for this course what we're going to cover and what we won't cover. So please use that index as a guideline to what you should be working through in the textbook. Right, so I've mentioned to you we're going to do capital allowances and leases today, and the reason we do these two topics together is because they are capital in nature. Okay, which if we think about our general deduction formula causes an issue for us, because the general deduction formula says you cannot get a deduction if something is capital in nature. Right. But obviously, within anyone's trade, there are capital assets. I mean, you cannot have a trade without capital assets. Now, you might have a building, you might have furniture, you might have a computer, a vehicle, whatever that capital asset is. In terms of the general deduction formula, there is no deduction, okay, which is why we need all these special deductions for our capital allowances, for these capital assets that we use in our trade. Okay, because without the special deduction, we wouldn't be able to deduct them. Now, you remember that the special deduction always takes preference over the general deduction. So if there's a special deduction, we use it first. Okay, and that is definitely going to be the case with these assets. We're never going to go back to the general deduction formula. We're simply going to use the specific deductions which we get. Okay, so in terms of the framework, we're still in the same place where you were for your last lecture. And we are still on this line where we're looking at specific deductions or special deductions and allowances. Okay, so just that is where your deductions would fit in the framework. Right, now these are just some of the sections which we're going to be dealing with over today's lecture. Okay, before I go into what these sections are, I want you just to think about assets that we could have in a trade. Firstly, we could have tangible and we could have intangible assets. Okay, so tangible assets being the ones that we can see, we can touch, okay, and those are the ones that we're going to deal with on this course. Okay, we're only going to deal with tangible assets. Now, intangible assets such as trademarks, research and development, there are specific deductions for them, and you will see it in the textbook, but we are not going to cover them in this course. Right, so today's focus is on assets, but just so that we don't forget, assets are broken into tangible assets and they are broken into intangible assets. Right, so it's not that there aren't deductions for intangible assets, it's just that on this specific course, we're not going to focus on them. Right, so today we're going to be looking at tangible assets, and we're going to split them into two further categories. We're going to deal with movable assets, and we are going to deal with immovable assets. Right. So if you have a look on the board, you will see that the first top two ones that we're going to deal with are our movable assets. Section 11E, okay, which we're going to deal with first, and then section 12 cap C, which is manufacturing machines. It also deals with aircrafts and ships. Okay? It also deals with some other assets, but for this course, that is all that we're going to have a look at. Then we're going to deal with our immovable assets, so our buildings. Okay, we're going to have our manufacturing buildings, which is section 13, residential buildings, which is section 13.6, and our commercial buildings, which is section 13 Quin. Right, so that's what we're going to do in the first part of today's lecture, is look at these movable and immovable assets. Okay, later on in the lecture today, we're going to get into our leases, and at the bottom here is the sections that we are going to do for leases. Lease premiums, leasehold improvements, and relief for the lessor. Okay, so that's just basically how the lecture is going to be structured. Okay, now let's just quickly speak about how we decide a capital asset or which section we're going to go to for a capital asset. Let's just take one step back. When we are working out these capital allowances on assets, we are saying that these capital assets that we have in our trade are busy depreciating or diminishing in value. As we use them, their value gets less, which makes sense. If I have a vehicle and I use it, the value of the vehicle decreases. If I have a computer and I use it, the value decreases. A machine, it decreases over time. So that is all these allowances are doing. They're giving us an allowance over the time that we are using that specific asset. Okay, can you think of one asset that we would have in our trade that wouldn't depreciate over time, but it would actually appreciate? Okay, so buildings actually depreciate because as we use the buildings, they get older and they do lose their value. But what else? I heard someone here say it. Land. Okay, so land appreciates. All right, so you'll see that nowhere in the Act do we have something that gives us an allowance on land, and that is the reason why. Okay, now when we get into mining and things like that, obviously we have different rules because there is some kind of depreciation on the land that they mine on, but there's very specific mining rules that applies to that. Okay, now we don't do mining on this course, so for our purposes, land never ever depreciates. All right, so there's no allowance for land. So if you have land in a question, you're simply going to tell me there is no tax consequence because land is capital in nature and there's no special allowance. Right, so we're looking at all other assets excluding land. Right, now when we deal with an asset, to decide which section we're in, firstly we have to decide what type of asset we're dealing with. Is it a movable or immovable? And then once we've decided what category it falls in, what type of specific asset is it? Is it a manufacturing machine? Is it a manufacturing building? Is it some other asset? Right, so firstly we're going to decide what type of asset it is. Secondly, we're going to decide what the cost is. Okay, and the section is going to tell us specifically what cost we must use for the asset. Right. Now, the general rule when it comes to cost is most of our sections tell us to use the lower of cost or market value. Okay, lower of cost or market value. So that is what we are going to generally use. Okay. Now, in today's lecture, I'm going to try and teach you what the general rules are, and then I'm going to show you where the exceptions are, because it just makes it a little bit easier to understand. So the general rule is that we use the lower of cost or market value. Okay, once we know which cost we're using, we then go and look at what the Act says in terms of a write-off period. Does it give us a specific percentage, 20%, 5%? Does it tell us to write it off over a specific number of years? Okay, and then we apply that. We also have a look at whether the section tells us that we should apportion that asset's calculation or not. By apportioning, I mean if I've only used the asset for 2 months in the year, I'm going to say times by 2/12. That's what I mean by apportioning. Okay, now again, the general rule is that we do not apportion. Okay, I'm going to show you where the exception lies, but the general rule, we do not apportion. Okay, so now we can't ignore what happens in accounting because that's where we start, right? We receive accounting records and we're now going to do the tax on it. Okay, now how are these capital allowances different from depreciation in accounting records? Okay, well firstly, if we look at the tax rules, we have very specific rules in our legislation. It tells you if you've got a passenger vehicle, this is how you're going to write it off. If you've got a manufacturing machine, this is how you're going to write it off. Okay. However, in accounting, management can use their judgment and they decide how long that asset will be used for. Its useful life. Right, so can you see that there might be a difference between, well, probably would be a difference between those two. There's the rule that the legislation gives us, and there's that managerial decision that is made in terms of accounting. Now, obviously, in our books, that creates a little bit of an issue, and for those of you that are in accounting, you will know that we refer to that as deferred tax. Okay, so in accounting, we've got this deferred tax thing that happens. Okay, now you don't have to worry about deferred tax. I always tell my students, tax is such a nice subject because we go in and we make accounting difficult. We create deferred tax and all kinds of things, but we don't have to worry about it. Okay, so that's the nice thing. We just have to follow the tax rules, but just keep in mind that it does create an issue when we look in the accounting records. Okay, but for our purposes, we're just looking at the tax rules, but both of them are working on the same principle. They are looking at what is the life of the asset, and we are writing it off over the life of the asset. Okay, so the important thing there is we are writing it off over the useful life of the asset as we use the asset. So all of our capital allowances, we are going to write off from the day that we start using the asset. So use is important. Right, so even if I've purchased an asset and I've just put it in my storeroom and it's sitting there, I will not be able to claim any of these allowances. All of these allowances kick in from the first day that I'm using the asset. Okay, because it's about writing it off over its useful life. Okay, so we have a couple of definitions that are important to us when it comes to capital allowances, and the first one is connected persons. Okay, now connected persons is someone that is closely connected to you, and obviously in tax in general, connected persons can create an issue for us. Because if I enter into a transaction with my sister, or if I enter into a transaction with my subsidiary company, okay, those are connected persons, there's always room for us to try and manipulate a transaction to get the best possible tax situation. Now, because people do that, we have a whole lot of rules written into our Act for connected persons. Okay, now you can go and look at the connected persons definition that we have in Silk, which is obviously comes from the definition in the Act. The definition is quite extensive and actually a little bit difficult to understand. Okay, for purposes of this course, we will tell you specifically this transaction was entered into with a connected person. Okay, so you just need to know what you're going to do if there's a connected person in the picture. Okay, you won't have to identify a connected person, but obviously in practice you would need to do that. Okay, so if it is something that you're working with in practice, you would go to the definition, check if someone is defined as a connected person, and then you would apply the rules. Okay. Right, the second one is machinery, plant, utensils, and articles. Now, I'm going to speak about that a little bit more when we get to 12 Cap C, which is our manufacturing section. The process of manufacture, I'm also going to speak about it over there when we get to section 12C. Okay. And then the last one is a depreciable asset, which is what we've been speaking about. Everything we have is a depreciable asset except for land. Okay, so land is not a depreciable asset. All right, so let's get into this first section here, which is our movable assets. And the two sections that we're going to focus on for movable assets is section 11E and section 12 Cap C. Right, now 11E, the one that we're going to do first, is the fallback section. It's the section that you're going to use if you don't have another section to use. Right, so you're going to check if you're sitting in movable assets, is there any other section that you can use? And for our purposes, we're only looking at 12 Cap C. So you're going to check quickly, is this asset a 12 Cap C asset? Now 12 Cap C asset is a manufacturing machine. If it's not, then you're going to apply 11E. Okay, so 11E is our fallback section. Right, you'll also see that it is a little less beneficial in the way that it writes off. It writes off the assets a little bit slower than our other assets are written off. Okay, but it's our fallback section, and it's where most of our assets, our general assets, fall. So furniture, computers, vehicles, any kind of office equipment, okay, those all fall under section 11E because there's nowhere else for them to be. Right. Now 11E is a bit of a funny section because it breaks two of those rules that I said. This is the general rule, but then there's an exception to the rule. Okay, and the first one is, I said, the general rule is that we always use the lower of cost or market value. Okay, however, 11E is the exception to the rule. 11E says use the value of the asset. Okay, now you might be thinking, but how is that really different? Because the value of the asset would be the cost of the asset, okay, which is probably right, and the cost is generally the market value. That's probably right, okay. However, value is a lot wider than saying the lower of cost or market value. Okay, value, let me give you an example. What happens if someone donates an asset to my business? Right, they donate a computer to my business and I now start using it in my trade. Can I attach a value to that asset? Okay, definitely. There's a computer, I can attach a value, and as soon as I can attach a value, I can claim an allowance for it under this section. Right, so even though I didn't physically buy it, I can claim an allowance. Think about the other sections. They say the lower of cost or market value. Now, if someone had donated an asset to me, my cost would be 0. So I would never be able to get an allowance for that asset. Okay, so 11E is quite nice in that regard, because if I have inherited an asset, if I have if someone has donated an asset to me and I'm using it in my trade, remember trade is always important because if I'm not trading, there's no deductions. But if I'm using that asset in my trade, I will be able to get a deduction under 11E. Right, so that is the first thing that is different for 11E. Okay, the second thing that is different for 11E is that we apportion our calculations. Okay, so all the other sections, I said general rule, we don't apportion. 11E, we always apportion. So I have to go and look, did I use that asset for 1 month out of the 12 months? Did I use it for 5 months? Did I use it for 10 months? Okay, and we're going to apportion the calculation. Okay, I'll do some examples just now, just to show you exactly how that works. Okay, but that is a big difference in terms of section 11E. Okay, so just to clarify, the question is regarding having an asset donated to your business that you're now using in the trade. Okay, so generally speaking, an asset that is donated to you, you wouldn't be able to claim under any other section because there's no cost incurred by you. Okay, but you would be able to claim it under section 11E. Because 11E says base it on the value. Now, if you donate an asset to me, let's say you donate a laptop to me, if I can attach a value to it and say the value of this asset is 5,000 Rand, I can use that 5,000 Rand and calculate a section 11E allowance on it. So 11E is the only section that will allow us something like that. Remember, all our other sections look at an amount that's actually incurred, or in terms of capital allowances, the lower of cost, which will be 0, so there'll be no deduction. Okay, so if an asset is donated to you, 11E is available for you to claim a deduction. Okay, does that answer your question? Okay, right. Okay, now here comes the next general rule for all our assets. The general rule is that an asset must be owned by the taxpayer for them to be able to claim the allowance. Right, now we speak about someone owning it straight up. So in other words, I've gone out and I've purchased it for cash. Or secondly, we also speak about an ISA, an installment sale agreement. Right, now we're not going to go into the definition of an installment sale agreement in this course. So we would just tell you that this is owned, either straight up ownership or there is an installment sale agreement. But essentially, an installment sale agreement gives ownership to the taxpayer in any case on that asset. It is just that they are paying off that asset over a period of time, but ownership does pass to them. Okay, so ownership is a general rule for all the sections that we're going to be doing today. Later on, I'm going to get into a section where there is an exception to the rule. Okay, so there is one section of our capital allowances that does not require ownership, but the rest of them do. So unless you own the assets, you cannot claim the allowances. Okay. Right, so we're working out the diminished value, okay, in terms of these allowances over the useful life of the asset. And again, there comes that thing, when the asset is brought into use. That is key to us for all these allowances. Okay, the cost of the asset, we've already spoken about that, is the value. Okay, now I just want to throw a little spanner in the works here, because what happens if someone donates a manufacturing machine to me? Now, generally, a manufacturing machine is going to fall under that section 12C, okay, that we're going to speak about in a moment. Now, if an asset is donated to me under 12C, I'm going to first go to 12C. 12C is going to say lower of cost or market value, which means cost is 0. So I can get nothing under 12C, even though it's a manufacturing machine. But our fallback section, section 11E, is always there. So if you can get nothing under 12C, you can fall back to 11E. So in the situation where a manufacturing machine is donated to a trade or to a business, they would be able to claim a deduction under section 11E. Right, it's just a bit of a funny situation because normally manufacturing machines are under 12 cap C. Right, so just keep that in mind. 11E is our fallback section. If you cannot get a deduction for movable assets anywhere else, you can fall back to 11E. Right, so how do we work out our allowances? Well, it's very simple. We take the value of the asset, which is normally the cost, the value, divided by the number of years that SARS gives us, and then multiply by the period of time that it's used in the year. Okay, so that is where the apportionment comes in. Okay, now where do we get this expected useful life, or the number of years? Right, so we go to our Act, and our Act doesn't give us a list of assets and things. Okay, so what we have is an interpretation note which is issued by SARS. Okay, so if you go to SARS's website and you search for interpretation note 47, okay, on SARS's website, it will throw up a PDF document that tells you how we're going to write off these assets over the useful life. Okay, and it gives us a whole list of assets that we can write off. Okay, a little bit later I'm going to show you what that interpretation note looks like, but for now just keep in mind that it gives us a list of assets that we can write off. So you're going to go through the list and you're going to identify where your asset falls in best. Okay, is it a passenger vehicle? Is it a delivery vehicle? Is it computer software? Is it a laptop? Okay, and for each specific asset, it's pages and pages, the document, that lists all the different assets that you can claim. Right, and in there it will tell you over how many years you're going to write it off. Okay, so interpretation note 47 gives us the number of years that we write it off over. Right, interpretation note 47 also gives us a little bit more guidance in terms of how we write off these assets. How do we apportion things? How do we work out the apportionment? Right, so it's just a guidance. Remember, the interpretation note is just there to help taxpayers interpret what has been written into the legislation. Okay, but that is what we're going to use in practice. Okay, now how is it going to work excuse me, in a test or an exam or even in an assignment? Well, it is open book, so you would be able to look it up, but we don't want you to spend hours looking up something off a list. So in a test or in an assignment, we will say something like, SARS allows the following write-off periods, and then we'll give you a list just with a few assets on. Right, so instead of giving you pages and pages and pages, we'll maybe give you 5 or 6, and you're just going to have to pick from those 5 or 6 where your asset falls. All right, because I'm sure if we gave you enough time, you'd be able to go to the full list and you'd be able to look for it, but that's not what we're trying to test. Okay, so we'll give you a few assets, you'll just have to pick from the few which one you are dealing with, and then you are going to apply the number of years. Okay, so let's have a look at an example together. Right, so this is a Section 11E asset. Okay, they tell us here, the 1st of September 2018, J Manufacturers, a sole proprietor. Okay, so what is the year end or year of assessment for a sole proprietor? Always 28 Feb, because it's a natural person. Okay, purchased a delivery vehicle for 114,820, including VAT. Okay, they brought it into use for purposes of trade. In terms of interpretation note 47, the write-off period for delivery vehicles is 4 years. Okay, let's just speak about that VAT thing. Okay, what did we learn about that when we did prohibited deductions? 23 Cap C says if you can claim the VAT, you take the VAT out and you're left with the amount excluding VAT. If you cannot claim VAT, you leave it in that cost. Okay. Now, in this situation, we're dealing with someone who is not a vendor. So, in other words, they won't be able to claim their VAT back. So, we're going to leave that VAT portion in the cost of the asset. And we're going to write off the asset, including VAT. Okay, if I change the question and I said to you, this is a vendor who claimed the inputs on this delivery vehicle, you would then take the VAT out. Right. So we're not going to integrate VAT too much into the things, but obviously in practice that's something that you have to be aware of. You have to identify whether the VAT was claimed and you're taking it out, or if you're leaving the VAT in the cost of the asset. All right. Okay, let's have a look at this example together. So it was purchased on the 1st of September. So we know that, and they tell us that it was brought into use at that point as well. So we know that they didn't use it for the whole year. So apportionment is going to kick in. Right, so they tell us that the cost is 114,820. They tell us interpretation note 47 writes it off over 4 years. Okay, and then here comes the apportionment thing. We have to figure out for how many months this asset was used in the year. Okay, well, they tell us it was bought on 1 September, and we assume it was brought into use at the same time, unless they tell us something else. So it would have been used for September, October, November, December, January, February. So it would have been used for 6 months. So here's the apportionment. 6 over 12, that is how we apportion. Okay? And so if you work that out, that should give you an amount of 14,353 Rand. Right. Okay, and that would be the allowance that we would claim on the asset. Okay, is everyone comfortable with what I've done in terms of apportionment? Remember, 11E is the only one that apportions. Okay. Right, so that's the only difficult thing about 11E is the apportionment. Otherwise, it's very easy. We get given the years, we simply divide our costs by it or our value by it, and we get our answer. So apportionment is the only difficult thing there. Right. Okay, we've already spoken about 11E being the fallback section. We're going to use it if nothing else is available. Okay, now, are we going to use the straight line method or the diminishing value method? Now, interpretation note 47 says we could actually use either, but generally people use the straight line method just because it's simpler. Okay, and you'll see in all our examples, in everything we do, we use the straight line method. Okay, but the diminishing value method is available should a taxpayer want to use it.
These methods the same as the accounting method?
So they are, in terms of being straight line and diminishing, that is the same terminology and the same way you would use it for accounting. Okay. Right. Okay, now interpretation note 47 gives us a little bit more detail as well. And one of the things that this interpretation note tells us that it says if you are purchasing an asset which value is less than 7,000 Rand, you can claim that asset immediately in the year of assessment. Okay, so you don't have to go to the list, figure out the number of years. You're simply going to write off the full amount in the year of assessment that you bring it into use. So for example, if I buy a laptop and it costs me 6,000 Rand, I can write off the 6,000 Rand immediately. Okay, so as soon as you see an asset that has a cost of less than 7,000 Rand, you can write it off immediately. Okay, just a little bit of guidance there because then people got clever. Okay, people always get clever and then we have to cover up with new legislation and new things. So people thought they were very clever and they would go out and do something like this. I want to buy a really nice boardroom table and boardroom chairs, okay, for my office. And so I buy it. And the table costs me 6,500 Rand. And I say, that's less than 7,000 Rand. I write it off. And each chair, all 12 chairs that go around my boardroom table, each of them costs 2,000 Rand. So I write off each of the chairs separately. Okay, do you think that is what was implied or what was meant? Okay, definitely not. Right, so interpretation note 47 specifically says if something is a set, a group of assets together, you have to look at the value of that whole thing together. That makes sense. Right, so people did try and manipulate it a little bit, but so a group of assets, I mean, what is a boardroom table without chairs? Okay, and what is one chair on its own? You have to use them together. So we would add the cost of all those things together, and obviously then it's not less than 7,000 Rand. Okay, so just keep that in mind, but the 7,000 Rand rule is a really nice one if you're buying small assets because you can write them off immediately then. Okay, right. Okay, so that was our first movable asset, was section 11E that we've now done. Right, now we're going to focus on section 12 cap C. Okay, and section 12 cap C is for our manufacturing assets. Okay, and it speaks about machinery, it speaks about plant, it speaks about articles. Okay, so any kind of equipment that you are using in your manufacturing business, you are going to write off under this section. Okay, now you'll see that when we get into the rates, this is a very beneficial section and it writes off the assets a lot quicker. Now, why do you think government would want to let people write off manufacturing assets quicker? Is manufacturing important to our economy? Okay, definitely, okay? And the more people manufacture things locally, the better it is for our economy. More jobs, okay? We don't really want to import things into our country. We're in a much better situation if we are manufacturing our own products. So to encourage manufacturers, this section gives them a really good or a very quick allowance. The assets are written off very quickly. The other thing that we must remember is that manufacturing assets are generally very expensive. Okay, now I remember when I was doing my articles and we went to audit, we were auditing a firm that was one of the car manufacturers, and we went into their manufacturing business. Now, I'd always learned about these manufacturing machines, and in your head you've got this little picture of a machine and it's standing there and it's like pumping out units. Not really sure what I thought, but I walked into this building which must have been 10 times the size of this lecture venue, okay, and a massive tall ceiling, and there was just this gigantic machine that filled this whole room. Right, and they had purchased this machine in the year, which is why I wanted to see it, and it had cost them, they had imported it, and it had cost them millions and millions and millions of rands. Okay, and then I started asking some more, and then I realized that they didn't just put the machine on a truck and dump it in the factory. In fact, the factory pretty much got built around it, and they had to dig these massive foundations to put this machine there. Right, so we're speaking about a gigantic outlay of capital. Okay, now for manufacturers, that's a big issue, because if they have to put this capital out there to buy their machines, cash flow could definitely be an issue. So to assist with that, SARS gives a faster write-off period so that they can recover from that cash flow issue and so that they can continue manufacturing. Right, we don't want them to close down and, retrench all the employees. So that is the reason these allowances are so much more beneficial in 12 Cap C. Okay, now, when are you manufacturing? Right, now it's easy. If I'm manufacturing a car, I'm manufacturing. If I'm manufacturing wooden boxes that I sell, I'm manufacturing. Right, but this section speaks about the process of manufacture or a process similar to it. Okay, so over the years, people have tried to prove that the processes they have are similar to this. Right, and they'll try anything. So what SARS has done to take the guessing work out of it is they have issued a practice note. And practice note 42 tells us when something is a process of manufacture or when it is a process that is similar to it. Right, so I quickly want to just open practice note 42 so you can see what it looks like. Okay, all the interpretation notes, all the practice notes are available on SARS's website. Okay. Right, so yeah, I've just opened up SARS's website, sars.gov.za. Okay, I know it's a little bit small, you might not be able to see this, but possibly you want to go home and see where all these things lie. But just to show you here, at the top here, there's a heading that says Legal Counsel. That is where I would be going into, Legal Counsel. And then a little bit further down is a heading that says Legal Advisory. I would be going in there. You'll see there's all my interpretation notes, and then there's my practice notes. Okay, so firstly, let's just quickly go in here. Okay, the first thing I want to do is just take a step back, and I'm going to go back to section 11E, and I want to show you what interpretation note 47 looks like. Right. Now it lists all the interpretation notes here. There is interpretation note 47. Okay, let's make it a bit bigger. Okay, remember it gives us all the details of how 11E works. I'm just going to go right to the bottom of the document where they start listing the assets. Okay, Okay, so this is our fallback section. This is where we come to look for the different types of assets which we may be using. Okay, yeah, they start. Now you can see there's all kinds of things. Adding machines, chillers, aircraft, battery chargers, carports, check writing machines. Not so sure there are many of those around anymore, but anyway, computers, computer software, curtains, drills, electric saws, hairdressers equipment. I mean, can you see that the list is extensive? Office equipment, navigation, plows, shop fittings, okay? Video cassettes, textbooks, okay? Even textbooks you can write off. X-ray equipment. Okay, now I've gone through it quite quickly, but that is the list that you would go to and you would find where your asset best falls, and that is where you would write it off. Okay, again, we'll give you a few to choose from, so we won't expect you to go through the whole list in a test to try and find it. But in practice, this is where you're going to go. Okay, right, but that was interpretation note 47. Okay, what I wanted to show you now was practice note 42. Okay, now, I know some of you work for SARS, so you're all very comfortable with how this website works, but I sometimes forget where to find things on SARS's website. So, if you are like me, you can just use the search function on SARS's website. It's actually a very nice search function, and you can see I've already searched practice note 42 before. You press enter, and it will throw it up for you. Okay, so just to show you, SARS's site is quite user-friendly in terms of its search functionality. If you're not sure where to find it, you search it and it will throw it up for you. Okay, what I wanted to show you here is what practice note 42 sees as a process of manufacture. Okay, so generally speaking, what we think is a process of manufacture, if I'm manufacturing something, it is a process of manufacture. But you'll see then that it goes a little bit further in this practice note. It gives even more things. So it gives things like smoking fish, crushing stone, printing. Now those things don't necessarily feel like manufactured to us, but we are told that they are. Okay? Photographic printing, manufacturing stationery, manufacturing bricks, retreading tire. Okay, so it gives us guidance. So it's either a process of manufacture, or the section says it is a process similar to manufacture. So practice note 42, if I go to the top here, will tell us when something is similar, and you'll see the list is quite long. Now this list is quite easy. Not easy. This list is quite interesting, what it sees as a process similar to manufacture. Dry cleaning, laundering, construction of roads, panel beating. Okay, now you wouldn't necessarily have thought those kind of things are manufacturing. Liquefaction of eggs, classification of sand. Okay, so you need to check whether the industry that you are working with falls on this list. Is it a process of manufacture, or is it something that is similar to that? Okay, now again, in a test or in an assignment, we're going to say to you, this is a process of manufacture, or SARS accepts that it is a process that's similar to manufacturing. So we're going to tell you that 12 cap C is applicable. But in practice, this is where you're going to come. You're going to come and see if the process that you're dealing with falls on this list. Because if it does, you can apply section 12 cap C. Okay, so this is where you're going to come when you're in practice, is practice note 42. Right, let's go back to our notes. Okay, so although we're not going to use these practice notes and we're not specifically going to use the interpretation notes, I do just like to show you where they are, because obviously I'm not just teaching you to write a test, you also need to know where to go in practice to make sure you are using the right thing. Right, let's go back to our slides. All right, now 12 cap C, I keep referring to it as the manufacturing section, but it is also a section that deals with other kinds of assets, okay? It deals with hotel keepers, which we don't do on this course, okay, the kinds of assets that they would have. The ones that we're going to do on this course are the manufacturing assets, and then also aircraft and ships. Okay, they also fall under 12 Cap C. But I'm first going to deal with the manufacturing assets, okay, because we do treat them slightly differently. Okay, and we deal with this section, we'll give a deduction for this new asset that we're using, as well as the improvement to any of these assets. Okay, now you'll know that a manufacturing machine, often there'll be new technology that comes out and they will be able to improve the machinery that they're using in their factories. Okay, those improvements or the cost of the improvements are covered under 12 Cap C as well. Okay, now when you have an improvement, the improvement, we are going to treat it as if it is a new asset. So you've got the original asset that you're writing off under the section. If you then pay R1 million for an improvement, that R1 million, we're going to treat as if it's a new asset, and we're going to start writing off that R1 million separately. Okay, so when we have a situation where there's the improvement, we've got the underlying asset and the improvement, and we treat them as if they're two separate assets, and we write them off separately, even though they are one and the same thing. Okay, so improvements we treat separately. Okay. Right. Yeah, we get to the rates that we're going to use. Okay, so we've got two rates that we get given for these assets. The general rule under Section 12 Cap C is that we use 20%. Okay, so that's 5 years. 20%. It's straight line. There's no apportionment. Okay, so all our general rules apply. No apportionment, straight line. We use the lower of cost or market value to calculate the thing. Right, so 20%. However, we have what we refer to as accelerated wear and tear on new manufacturing machines. So if I have a new and unused manufacturing machine, the Act says that I can write off 40% of that asset in the first year. And then 20%, 20%, 20%. So I write it off over 4 years, 40% in the first year, and then 20% each of the other 3 years. Right, now that might sound okay, but go back to my example of that big machine that was purchased for that motor manufacturing company. 40% of millions and millions and millions is a lot. All right. So it's a really, really beneficial section, and it's to benefit those manufacturers who are purchasing new assets. Okay. So you always have to identify whether the company or the business is purchasing a new or a second-hand manufacturing machine. Because new will be 40% and then the 20%, and second-hand will be a straight 20%. Okay, so keep that in mind. Okay, we've spoken about the cost of the asset. We've said that there's no apportionment, right? The only other thing that makes, so 12C is actually pretty easy because it's just, you're either applying 20% or it could be 40%. Very easy calculation. The only thing that makes 12C a little bit difficult is it speaks about this thing of moving costs. Okay, so if I have a manufacturing machine in one factory, and after a few years of using it, I decide to move that machine to another factory. And again, we're not talking about a little small machine that I'm just going to throw on the back of a bakkie and drive. We're talking about a big machine being moved to another premise, okay, which would mean that moving costs could be really, really expensive. Okay, so 12C tells us how we're going to treat moving costs. And it says, if you have this asset that you are moving, what you're going to do is you're going to look at the underlying asset that is being moved, okay? And you're going to figure out how many more years this underlying asset has to be written off, including the current year. So let's just say, for example, if I've got a machine that's been written off on the normal 20-20-20, so over 5 years, if after 2 years I move it, I still have 3 years to write it off. If that is the case, I'm going to take my moving costs, whatever that is, and divide it equally by the 3 years that are left. If there's 2 years left, I'm going to divide it by the 2 years. If there's 1 year left, I'm going to write it off in that year. If I have already written the asset off, let's say, for example, I move the asset in year 6, right? If that is the case and there's no years left to write it off, The moving cost I will claim immediately in the year of assessment where I incur it. And again, moving costs could be a lot of money. It is expensive to move manufacturing equipment. Right. So that is the one thing that makes it a little bit tricky. Okay. So that being said, let's have a look at an example where there are moving costs involved. Okay. I want to give you a few minutes to try and do it on your own. You'll see that there's two assets, two manufacturing assets in this question. Okay. You're going to have to figure out how many years of these assets have been written off, and then figure out how many years are left, and then decide how you're going to write off the moving costs. Okay, because we've asked you, we've moved the assets in this year, and we've asked you, this is a sole proprietor, so 28 Feb year of assessment. We want to know what is deductible in the 2019 year of assessment. Okay, I'm going to give you a couple of minutes. Try and figure it out on your own, and then we'll do it together on the board. Okay, let's have a little bit of a chat around it together. Okay, so I'm just going to show you how I would approach something like this. I struggle to process a lot of information and figure things out. So whenever I'm given lots of information, I draw a timeline. Okay, now you might be clever and you can picture it in your head, and that's great. But for those of you who struggle to process a lot of information, I want to recommend that when you are sitting with a scenario like this, that you draw some kind of timeline or whatever, some kind of picture where you can have all the information. Okay, so this is what I would have done here. Okay, if it is a bit unclear, what I will do after the class is I will just load all of these things that I do on the board today onto ClickUp as well. So don't feel that you need to write everything down. But what I did is I put everything onto my timeline here. And when I'm doing a timeline, I always like to put in my year of assessment. Okay, so for me, I always put in a little star, and you'll see I've put in each of my years of assessment in. And then I've added in the other information that we had in the question. We had machine 1, which was purchased year, new and unused in 2014, and then machine 2. Okay, now the reason I do that is because we're trying to figure out how many years are left over to write this asset off. Okay, now what did you figure out? How many years were left over of asset 1? Nothing, hey? It was written off already. Okay, and the reason being, because it was new and unused, we were on the accelerated wear and tear. So yeah, in 2014, we would have already written off 40%, 2015, 20%, 2016, 20%, and 2017, the last 20%. Okay, so it is fully written off. Okay, so we know that in the 2019 year of assessment, there is no wear and tear on machine 1. But what does that mean in terms of the moving cost? We're going to write it all off in this current year. Right, and they told us that the moving cost was 5,000 Rand for machine 1. So for machine 1, that moving cost, because it is already written off, the moving cost, I'm just going to claim the full 5,000 Rand in this year. Okay, so that was machine 1. Tell me about machine 2. How many years were left over of machine 2? Okay, 1 after this year, but including this year? It was 2. Okay, let's just check ourselves. If we go back to our little diagram, okay, we've got it here from the 1st of June 2016. So yeah, by Feb 2017, again, it was a new and unused machine. So 40 in this first year. Then 2018 will be 20. 2019, this current year, is going to be another 20. And then 2020 is going to be my final year. Okay, now, when we're looking at moving costs, we're saying how many years are left over, including the current year. Right, so including the current year, we've got 2 years left over. Okay, so how would that look in terms of our calculation? Well, firstly, don't forget about your normal Section 12C allowance, okay? You've still got an asset that's been written off here. It's an asset that cost us 200,000 Rand. In the current year, we are writing off 20% of it, okay? Which means our allowance in the current year just on the asset is 40,000 Rand. And then in terms of the moving costs, they tell us that the moving cost is 9,000 Rand for this asset, and we divide it equally by the number of years left over, including this year. So we divide it by 2, and our moving cost that we claim in this year is 4,500 Rand. Okay, so moving costs, not difficult. The difficult part is figuring out how many years are left over to write off the asset, and then you write it off equally over those years. Okay, but 12C is easy because there's no apportionment. So our calculations are pretty easy. You're just deciding, are you applying the 40% in the first year? Are you applying 20%? And then you just write it off on the straight line method. Now remember, we're not apportioning. So it means if I use that asset for 1 day in my year of assessment, I can claim the allowance for the full year. Right, so if the manufacturing machine is brought into use on the last day of the year of assessment, if it's a new one, in that year, I can claim 40%. Right, so that's what makes this a really nice, beneficial section. There's no apportionment. It's very quick write-off and definitely more beneficial to the taxpayer. Okay. Now remember, the other thing that I told you about this section is if you have an improvement, the improvement, you're going to treat it as if it is a new asset. Right, and you're going to start writing off that asset. If it's a new cost, a new asset that's never been used, which an improvement usually is, you're going to write it off 40, 20, 20, 20. Right, so an improvement you treat as a new asset. A moving cost, you look at the underlying asset, you look at how many years are left, and you write it off over the remainder of the period. Okay. Now these rules that I've taught to you about an improvement and the moving cost, we normally see them in 12C because it makes sense for a manufacturing machine. But the same rules apply to a section 11E asset, so the one we did just now. Okay, and we would apply them in exactly the same way. So if you had a moving cost under 11E, you would do the same thing. You'd figure out how many years are left, and then you'd write it off over that time. If there was an improvement, you would treat it as a new asset. Okay, now I explained it here because usually this is where it happens. I mean, normally an 11E asset is, here's my laptop, I move it. I mean, is there a cost involved? Not really. Okay, but if there is a cost involved, you would claim it in the same way that we did here. Figure out how many years are left in terms of a write-off and write it off equally over those years. Okay. If we're in 11E, okay, yes. So the question was, would it be broken down into months if it is in 11E for moving costs and things like that? Yes, it would, and that's where it makes it a little bit more difficult. Okay, because 11E deals with apportionment, you would have to apportion it in terms of how much time is left over. Okay, right, but again, from a practical point of view, this is where we normally see it, is moving costs we see on manufacturing machines. Okay, right. Okay, so that is the manufacturing part of 12 Cap C. Right, but you'll remember I said there's other assets that we deal with under 12 Cap C as well, but the only ones that we're going to deal with on this course is aircraft and ships. Okay, and very simple, aircraft and ships, we're simply going to use the 20% rate. Okay, it doesn't matter if they're new, if they're unused. If you're using them in your trade, you can claim them under 12 Cap C, and it is a straight 20%. No apportionment. Okay, and you'll see that, yeah, there's no accelerated wear and tear. There's nothing about a 40% that we can use. It is a straight 20% per year. So just be careful if I give you something in a question, even if I tell you this aircraft that I'm using in my trade is new and unused, it doesn't matter. We simply apply the 20%. Okay, and that's all that you need to know. You'll see when you are in silk and you're dealing with 12C, it does speak about the other assets, which we are not going to do on this course. But obviously, if it is something that interests you or something that you are using in practice, you might want to work through the rest of that section. But for our purposes, we're only looking at the manufacturing machines, manufacturing utensils, manufacturing equipment, and then we're looking at aircraft and ships. Okay. Right, so that brings us to the end of our movable assets. Right, because you'll remember that we said we're only going to speak about section 11, section 11E and section 12 cap C. Right, so again, just to confirm what you're going to do, because 11E is our fallback section, you're going to go to section 12 cap C, check if your movable asset falls in there. If it does, you're going to claim under 12 cap C. If you cannot claim under 12 cap C, you're going to fall back to section 11E. Okay. Right, and that's movable assets. It doesn't get more difficult than that. Right, let's quickly speak about immovable assets. Okay, the immovable assets that we are going to deal with on this course, okay, firstly is our section 13, section 13 assets, and sometimes we refer to it as section 13.1. Okay, and this is for our manufacturing buildings. Right? Then we're also going to speak about section 13 Quin, which is for our commercial buildings. Okay, so for example, an office block, something like that. And then we're going to speak about our residential buildings. Okay, and I just want to show you that under residential, it is section 13.6, which we're going to deal with, and it is section 13 Quin. Now, they both relate to residential buildings. The one that we're going to deal with on this course is 13.6, which deals with the actual allowance on those units. Right. We are not going to deal with 13 Quin. 13 Quin deals with if there are loans on those buildings and what we do with those loans. Okay, if you carry on and you do our next course, okay, the graduate level course, we deal with it there. But for these purposes, or for this course, we're only going to deal with the actual allowance on the building, which is 13.6. Now, you might be wondering about the funny numbering. Okay, 13.6 and Quin, where do those funny names come from? Purely just the Latin numbering that has come into our Act. Okay. It's always a big joke when I do this. I mean, my second year students, when I say we're doing section 13.6, their eyes are like this big. Okay, so it's just the Latin numbering that we have in our Act, and that is where those words come from. Right, so we're going to look at section 13, 13 Quin, and 13.6 today. Those are the only ones that we are going to do. Right. Now, it is fairly recent that we can get deductions on a commercial building and also on a residential building. Now, I want to say up front that these two that are relatively new to our Act, okay, these two you can only claim on a new and an unused building. Right, so 13 Quin and 13.6, you're only ever going to claim if you are building a building or if you are buying it from a developer. Right, and people often forget that. Okay, it's not if you're buying a second-hand building. Section 13.1, our manufacturing buildings, that's different. If you are buying a second-hand manufacturing building or you are constructing a new one, section 13.1 is available to you. Right, so just keep that in mind with the buildings. That's something that's quite different there, is those two bottom ones are only available if it is a new and an unused building. Okay, so unfortunately, if you buy a second-hand office building, there is no deduction. Okay, let's quickly speak about section 13. Okay, I'm just going to do section 13, then we'll have a break, and then after the break, I'll do the other buildings. Okay. Okay, now section 13 has been in our Act for a really, really long time. Okay, it has been there forever. Okay, well, it feels like that to me. Okay, and I remember when I studied, if you go and look at section 13, it's got all these different rates in. At some point, we could claim 5% on the buildings. At some point, 10%. At some point, they had what they referred to as an initial allowance. So in the first year, there was this extra percentage, and then 2%, and then it's like they couldn't make up their mind about what we should be claiming on these manufacturing buildings. Okay, now firstly, what are we speaking about? We're speaking about a manufacturing building, somewhere where we are manufacturing. So we've already spoken about manufacturing and what it is. It's the building in which this happens. Right, so this section has been around for a really long time, but in 1999, it changed to 5%, and it hasn't changed since then. Okay, so just a little aside, this year, every year I feel like I'm getting older with the students, but this year I was telling them, and when I studied, I had all these different rates to study, but 1999 is a fair amount of time ago, and so now we're just going to study the 5%. And I saw them looking at me, and then I realized, and I said, were you born? And they said, and then I realized, okay, but I'm sure most of you were born in 1999, okay, and it is a long time ago. And so that is the rate that we now apply. So if you were to look in the Act, you'll see that all the old legislation is still there with the old rates, the old initial allowances, but we simply are going to use this 5% now. You're also going to see that this 5% is our general rule for buildings. So all the building sections that we do here are going to apply the 5%. Right, so I always say to the students, I don't want you to hit a blank in a test, but if you're sitting in a test and you have no idea and you see a building and you really can't remember, just apply 5%. Okay, because it's the general rule. However, there are specific requirements that need to be met before we apply it. Okay, and those requirements for Section 13, it can be a new and unused building for Section 13.1. However, if it is second-hand, we have to look at who owned it before and whether they claimed the allowance before. So if I've purchased the asset before I can claim Section 13, if I've purchased it from someone else, so it's now second-hand to me, I will only be able to claim Section 13 if they were able to claim it. So in other words, they were using it for manufacturing. Okay. So that's the first thing. Or I've built it myself, so no one's used it before. Okay. Or I've purchased it from a developer, it's never been used before. Okay, so those are the three things. So either it's new, I built it, or I bought it from a developer, or if it's second-hand, I need to check that the person before was claiming this allowance. Right. And then we need to check what this building is being used for. And Section 13.1 says that it must be used wholly and mainly for manufacturing. Okay, now whenever we speak about mainly in our Act, we are speaking about more than 50%. Okay, so if the building is used more than 50% for manufacturing, you can claim the building under here. Okay, now this is where people get confused. Let's say, for example, I've got a manufacturing building. My machines are in there, but in the corner, I have constructed a little office where some of my admin staff sit and work. Right, now if I had to break the floor space up, 80% of that would be used as my factory for manufacturing, and in that little corner that would make up 20% would be for the admin side. Okay, so 80 manufacturing, 20 admin. Okay, now this requirement just says it must be used wholly or mainly for manufacturing. Okay, is it used wholly or mainly? Yes, definitely. Right, how do we work out the allowance? We don't split the building. If the building is used wholly or mainly, we claim the whole building under this allowance. Okay, so people get a little bit confused by this rule and they want to apportion the building, and that's definitely not what we are doing. We are taking the whole building and we are then writing it off on the 5% here. Right, so it's fine if a portion of the building is used for something else, as long as it is mainly more than 50% of it is used for this building. Right, cost of the asset. Okay, we've said that our general rule is the lower of cost or market value. This is also one of those sections that is a little bit different. And in this section, and I think it's because it's been in our Act for so many years, but what the wording is in this section is it only refers to the cost. Okay, so your cost that you incurred for this asset is what you will use to work out the allowance. Right. Okay, let's quickly just speak through this example that's on the board here. Okay, maybe before I speak about the example, Something that I want to mention about section 13. Remember I said I'm always going to teach you the general rule and then I'm going to teach you where an exception lies. Now there is an exception to the rule in section 13. One of the general rules I taught you is that the taxpayer must own the asset, okay, to be able to claim the allowance. Now that is true for all our sections except section 13. Section 13 doesn't speak about ownership. It simply speaks about you incurring that cost. Now, generally speaking, the person who incurs the cost would be the owner, because I don't know about you, but I'm not going to pay for a building and then give someone else the ownership. Okay, so generally speaking, in any case, we have an ownership situation. However, later in the lecture, I'm going to come back to this when we're dealing with leases, where there could be a situation where there isn't ownership involved. Okay, and then section 13 is the only capital allowance that allows us a deduction if we are not the owner. Okay, all the others require ownership. Okay, so that's the one funny about section 13. Let's quickly have a look at this question. So this is just sort of in principle whether we would be able to claim a deduction or not. Okay, so we've got a company here, Maxim Pty Limited, 30 June year end. They've purchased, okay, just ignore the word new because in some scenarios it's going to be new and other times not, for R1 million. Ignore that. Okay, it was purchased on 30 May 2018. What would the tax effect be in each of the circumstances? Now we basically give you 3 scenarios. Okay, let's start with the first one. It was purchased from a company who had previously used it. Okay, so it's a second-hand building, and they had previously used it as a storage warehouse. Okay, can we claim section 13? Okay, storage is not manufacturing, hey? Okay, so did that previous owner claim section 13? No. Right, so we can also not claim section 13, unfortunately. And so we lose the allowance. And there isn't another building allowance another building section that's going to give us an allowance. Because look at our other building allowances. They want a new and unused building. Okay, so that's the one thing that is a bit tricky with a manufacturing building is if it is second hand and the person before didn't claim the allowance, you lose the allowance on that building. Okay. Second one, purchased directly from the developer and now we use it for manufacturing. Yes, I can claim it. Purchased from a company, so second hand, who previously used the factory to manufacture products. Yes. Okay, so the bottom 2, I would be able to claim it. And our calculation would be very simple. No apportionment. Remember, 11E is the only one that apportions. No apportionment. I'm simply going to say 1 million rand times by 5%, and that 50,000 rand is going to be my allowance every year for the next 20 years. Right, so our buildings are always written off at 5%, which is over 20 years. Okay, so section 13, not difficult. Just check if it is second hand, what the previous owner used it for. Okay, but a good question. Despite you thinking that it's a silly question, the question was about would there be moving costs? Okay, so remember, it's an immovable asset. Okay, so there would never be moving costs involved in an immovable asset. Okay, but I'm glad you asked it because maybe some of you were wondering about that. Moving costs would only ever be applicable to those 2 sections there because it's an immovable asset. Okay. Any other questions on section 13? Okay, so just to pick up from where we were, we're still busy with our allowances on our assets. We're still busy with our immovable assets. Okay, we did our manufacturing building, but we're now going to look at the 2 buildings, section 13 Quinn and 13.6, which both require that the buildings are new and unused. Okay, so for both these sections that I'm going to do now, you will never be able to get the allowance if you have purchased a second-hand building. Okay. Now I'm going to start with 13.6 that deals with our residential units. And firstly, we're looking at new and unused units. And then you're going to see that we're also looking at someone who owns 5 or more units. Right. So it's not just a case of, and also they're renting them out for residential purposes as part of their trade. So it's not someone living in residential units. It's part of their trade. They're renting them out, or their employees are staying in it. That's also part of the trade, okay, for 13(6) to apply. Right, so it won't apply in a situation where, for example, I might have one investment property. Let's say I've got a flat that I rent out and I earn rental income on it. Obviously, that rental income is gross income in my hands and I've got this trade, but I will never be able to claim an allowance on that building because that is one of the requirements, is that there are 5 or more buildings in South Africa. Right, now why was this section brought into the Act? How important is housing to us? Very. Do we have a shortage of housing in South Africa? Huge, right. So if we can encourage people to build more housing by giving them a tax allowance, that is one way to encourage the development of new housing. Okay, so that is why it is for new and unused units, because we want people to develop more. And secondly, we want them to develop lots, so at least 5 units before you get the deduction. Okay, so just if you can understand the rationale behind a section, it makes it a lot easier to remember the requirements. Okay, so that's where it's not just like random, okay, let's make it 5 units. There's definitely rationale behind that. And as we get into the section, and I speak about the low-cost units, you're going to see that there's even more rationale behind how this came into our legislation and the reason for it. Okay, so our general rule applies to this section. No apportionment, okay, general rule. General rule for buildings, 5%. General rule calculated on the lower of cost and market value. So all of those general rules apply. Okay. Must be used for the trade, must be new and unused, and there must be at least 5 units in SA before you can claim it. Now this allowance, although it gives us 5%, the section says if you are putting up and building low-cost housing, then you can get an even more beneficial percentage. You will get an additional 5%. So if you put up low-cost units, instead of claiming 5% per year, you will be able to claim 10% per year. Right, so again, definitely makes sense. We're trying to create housing, so if people are putting up more inexpensive houses, it creates more housing in our country. Right, so that is where we look at what a low-cost unit is. Okay, now what makes this section a little bit difficult is that this is based on, or this allowance is based on the cost of the building of that unit, which is a little bit tricky because a building doesn't always stand on its own. A building stands on a piece of land that obviously has some value attached to it. So when we are speaking about the value of this building, or in terms of looking at whether it's low cost or not, we are talking about the value of the building on its own. Okay, so we would have to differentiate between what the cost of the land is and what the cost of the building is. Okay, and the Act says to us, what is a low-cost unit? Okay, well, it splits it into 2 parts. It says either you have a standalone unit, so for example, a townhouse, something like that, or you have something in an apartment, so like in a block of flats. And if we're looking at those, we give them 2 different values. So firstly, if we're looking at an apartment, it will be seen as a low-cost unit if it costs 350,000 Rand or less. Okay, and if we've got a standalone unit, remember just the cost of the building, must be 300,000 Rand or less. Right, so just 2 different values there for us to identify if it is a low-cost unit or not. Right. Secondly, it tells us for this to be a low-cost unit, the rental that is charged on this unit, okay, must be less than or equal to 1% of cost. Now again, why do we put this thing in there? Well, we don't want people to put up loads of housing and then charge ridiculous rentals and be able to get the deduction. So for it to fall under low cost, the rental must be less than or equal to 1%. So for example, if we look at a flat, Let's say the apartment cost me, or the flat cost me 200,000 Rand. Okay, then I'm saying 1% of that is 2,000 Rand. The monthly rental must be 2,000 Rand or less to fall under this cost, or to fall under the definition of low cost. Right, so you take the value of your cost, multiply it by 1%, and just check that the monthly rental is under that. Okay, now the same applies to both of them. The only difference is for the standalone unit, the Act recognizes that a standalone unit, when someone's renting a standalone unit, they're renting it and they're paying extra because they have a piece of land around them where they can let their children play or their animals run around. Right, so obviously for them to get the rental at 1% of the cost of the building would be a little bit difficult. So it says when you are calculating the cost of rental for a standalone unit, you're going to say the cost of the building plus a proportionate piece of the land. So in other words, just add on what the cost of the land would be, take those amounts together, multiply it by 1%, and the rental must be under that. Okay, now I don't want you to get too stuck on it because for purposes of this course, we're not going to go into detail. But if you are out in practice, that is what you're going to have to do. So cost of the land plus the cost of the building times by 1%, and the monthly rental must be less than or equal to that. Okay. Right, now you'll see in questions, we'll keep it very basic. We're not going to get into too tricky scenarios with this. The other thing that we must think about now is, let's use my example of a flat that costs 200,000 Rand. My monthly rental must be 2,000 Rand or less. Okay, that's fine for year one. What's going to happen in year two? Do you think I'm going to leave it at 2,000 Rand? No, I'm not going to leave it. So does that mean in the next year, I fall out of the definition of being a low-cost unit? Well, no, that is also not what the Act wanted to happen. So essentially, they built something in which allows for a 10% increase each year. And the wording's a little bit funny, but it literally just allows for a 10% increase in the rental. It says when you're standing in year one, take the cost and multiply it by 1% to get what your rental needs to be. When you get to year two, take your cost plus 10%. So if my cost was 200, now it's 220. Multiply that by 10% to get what your rental can be. So in year two, it can be 2,200 Rand. So essentially, funny wording, but essentially the rental can just increase by 10% per year, and you will still fall under the definition of it being a low-cost unit. Okay. Also, I'm not going to test this in huge amounts of detail because it's quite technical, but if you can just understand that it makes sense, surely the rental must increase. Okay, so if you understand that that's what the Act is doing, then you're 100% fine. Okay, so in a question, we might give you the cost of the unit and the rental, and you must just quickly work out for me if it's a low-cost unit or not. If it's not low-cost, you get 5% per annum. If it is low cost, you get 10% per annum. Right, just remember the first requirements must be met. At least 5 units in South Africa used for your trade. Right. Okay. Now we get to what the cost of the asset is. Okay, now I've already said to you that we're going to use the lower of cost or market value. But I also mentioned to you that the section is based on a calculation of the building itself. Now, it's pretty difficult to work out just what the cost of the building is, right? Because when you enter into a contract, and if you buy a townhouse, in the contract, does it say the house's value is this, the land? No, there's one price that you're paying. Right, now, if you could split it, if you have that split, that's great. Then you can use that split and you can say the cost of the building is X amount, and then I work out the allowance based on that. Right, and that's ideally what we're going to do, is we're going to try and split it, and I'm going to claim it just on the cost of the building. However, if I cannot make the split, the Act gives us some guidance, and it says, if you are buying a part of a building, now when you're buying a flat, you're always buying a part of a building. If you are buying a part of the building, you take your cost and you multiply it by 55%. Now, all that that's trying to do is it's trying to say 55% relates to the cost of the building, and 45% relates to the other things that you've purchased with that flat. The common parking area, the park that's in the flats complex. Right, so the Act just gives us a percentage to be able to split it. So as soon as I tell you I've purchased a part of a building, you're going to take my full purchase value and multiply it by 55%. Okay, the Act also gives us a little bit of guidance, and it says, if you have purchased an improvement, okay, so you might own this flat and now you purchase something as an improvement. So maybe they build a parking garage on the flat's premises and you buy that part of an improvement, okay, that goes together with your flat. Then that improvement, they say, take the value of the improvement and multiply it by 30%. And again, all it's trying to do is pull out the building portion and pull out the land portion. Okay, and people get stuck on this thing. Okay, don't get stuck on it. It's just a rule in our Act. Number one, if you can split it and or on your own get the value of the building, then you're fine. You just take the value of the building and multiply by 5% or 10%. But if you cannot, you have to apply the 55% if you're purchasing part of a building and 30% if you're purchasing an improvement. Okay, don't get caught up in the rule, because everyone always says to me, but how did they get to the 55? How? I don't know. Okay, is it accurate? Probably not. Okay, but they had to give us some guidance. So that was the guidance we were given in the legislation. Okay, so now you're going to see that this rule that I've just taught you, the 55% rule and the 30% rule, is also going to apply to the next section that we do. Right, same principle. We're trying to pull out and split building and land and everything else that goes with it. Right. Okay, but essentially, if you can just in your head think we're trying to just get the cost of the building, and then you can work it out. Right, let's have a look here. We've got a company with a 30 September year in. They constructed a complex. Okay, it's part of their trade in the west of Pretoria. 20 standalone units. Okay, let's just quickly go back here. Standalone units, when are they low cost? When they are less than or equal to 3,000 Rand. Not 3,000, let's try again. 300,000 Rand. Okay, that should be nice. Okay, right. We would definitely not have a housing problem if that's what houses cost. Okay, okay, 20 units. Right, so are we meeting the requirements? Yes, more than 5 units, definitely. Right, construction was completed on 30 November. Okay, when construction was completed and use happened or started happening is important to us with all our assets. Okay, no apportionment in the section, but we need to figure out if they started using them in this year. Right, 10 of these units were constructed for 500,000 Rand each. Are they low cost? No, definitely not. Okay, and the rest were constructed for 280,000 Rand. Okay, is that low cost? Yes, but we must just check the rental still. All units are rented out at 0.9% of their cost price. Okay, so we'll just tell you in that sentence that they are low cost. Right. Let's quickly do a calculation to see what we would be able to claim on these buildings. Okay, so we've got 10 that are low cost and 10 that are not low cost. Right, so let's start with the 10 that are not low cost. Okay, so they tell us 10 were purchased for 500,000 Rand. So 500,000 is the cost of the building. Okay, they didn't tell us we're purchasing a part. This is just the cost of the building. So straightforward, 500,000 times 10 units times by the general rule, 5%. Okay, so if you work that out, that would give us an allowance of 250,000 Rand. Okay. Nothing difficult. No apportionment, nothing strange. Okay, the second lot we know are low-cost units. So it's 280,000 Rand times by the 10 units. But then, remember, because they are low-cost, we can now apply the special rule that says we can apply 10% per annum. Right, so if you work that out, for those units, we will get a deduction of 280,000 Rand in the year. Okay, just to paint a picture for you, what's going to happen? These top 10 units, because we're writing them off at 5%, this will be written off over 20 years. Okay. The second lot of units, we're writing off over 10 years. So our allowance will stop for the top one after 20 years. It will stop for the bottom one after 10 years. Right, so just to keep in mind how long we're writing it off for. Okay, and that is how Section 13(6) works. Not difficult. If you meet the requirements, you get the deduction. If it's a low-cost unit, you get 10%. Okay, is everyone comfortable with how our residential units work? Okay, I think the biggest mistake people make is they see there's a section for residential units being used as trade, and they immediately think about that person that has got that one investment property, and it's not about that. It's about someone who has 5 or more, and they have constructed them new. It's not second-hand buildings that we're buying. So when we're talking about buying a part of a building, I'm buying a flat from a developer who's put up that building. Okay, must be new and unused. Right, so let's quickly check in. We've now done 13.1, we've now done 13.6, so the only one remaining is 13 Quin, which is our commercial buildings. Right, but a very easy section. Okay, now 13 Quin came into our Act in 2007. Before that, we didn't have any allowances on commercial buildings. Now, a commercial building is anything that you're using it for commercially. So it could be a shop, it could be an office, it could be a storeroom. Anything that you're using a building for commercially, you can claim under 13 Quin. Okay, but again, it has to be new and unused. Right, so it cannot be a second-hand building, must be new and unused. Oh, sorry. Okay, it must be used wholly or mainly to produce income, must be used in your trade. Okay, it doesn't give us a specific use, it just says it must be used in your trade, commercially, to produce income. Okay, so it includes all kinds of other buildings. Okay, and it specifically excludes residential units. So you could never try and claim a residential unit under here. Okay, that is why we have 13.6. Right, general rule applies, 5% on buildings, not apportioned, lower of cost and market value, must be the owner. So all our general rules apply here. The only thing that's funny with this section is the same thing that I taught you under 13.6. Again, just because we're trying to split this and pull out what is the building and what is the land. In 13 Quin, if you purchase a part of a building, you're going to multiply it by 55%. If you purchase an improvement, you're going to multiply it by 30%. Okay, again, just to pull out a portion of the land. So the same rule applies there. Okay, so just to show you how this 55% rule works, we've got an example here where we say Sandra, so she's a sole proprietor, purchased the second floor, so a part of a building, of an office building directly from the developer. Okay, that's important. It's new and unused if it comes from the developer. For 1.5 million Rand on 10 January 2019. She will use these premises to operate her sole proprietorship from. Okay, so they don't even tell us what she's specifically using it for, but it doesn't matter if she's using it in her trade to produce income, you fall under Section 13 Quin. Okay, can she get a tax deduction? Yes, she can get a tax deduction. The question just for us now is what will her tax deduction be? Okay, so let's quickly do this example. Okay, we know that she meets all the requirements, new and unused, it's used in her trade. The only thing that we know we need to apply here is she's purchasing a part of a building, so we need to pull out the portion of the land cost. So the way that we're going to do that is we're going to say the cost of that building, which is 1.5 million rand, we're going to multiply that with 55%. Okay, so we're pulling out just the building cost, and then we're going to apply the 5%. So essentially what the Act is doing is it's saying, if you take your total cost and you multiply it by the 55%, you should be left with a value that reflects the value of the building only. In this case, it's 825,000 Rand. Okay, again, whether it's very accurate or not, we don't know, but this is how the Act gives us guidance. And essentially, we're just claiming the 5% on that 825,000 Rand. And if you work that out, the deduction every year for her would be 41,250 Rand. And that would be the allowance that she once again claims over a period of 20 years. Okay, so that is how we apply the 55% rule in an example. Okay, any questions on section 13, Quinn? All right, so what we've done, okay, yes, sorry.
Can you take there was a building in the land, commercial, doesn't matter, buy it, demolish it, build it, say it's new and unused?
Okay, so you want to buy a building that's second-hand, then you want to demolish it, and then you want to build a new building. You've got lots of energy and patience. But yes, as soon as you're building something new, yeah, so that would be fine. Practically speaking, I'm not sure you would do that, but yes, as soon as you're building, and also, I mean, remember, this also applies to improvements. So you might buy a building that's second-hand. You won't be able to claim it, but you might renovate it and build on a storeroom. Now, that improvement part is new. So that improvement, you would be able to claim 13 Quinn on it. The original building, which is second-hand, you wouldn't be. Okay. So as soon as there's that element of it being new, you can definitely apply 13 Quinn. Okay. Right. Okay, so that brings us to the end. Yes.
So then, if say you qualify, right? But in your e-filing, you don't have all these things you qualify for. Do you get the deduction as far as rectifying, or don't you get it?
Okay, so just so I understand, so why do you say, I'm not sure I understand your question. On e-filing, remember how it works on e-filing for a company. It's going to start with what your financials look like in terms of accounting. And then it's going to say add back your depreciation, right? So your accounting depreciation. And then there's lines that give you space to fill in your wear and tear. So these calculations of your wear and tear, you're all going to do somewhere separately. So you're going to have a record of how you got to these things. And you're going to fill that amount into your e-filing as your wear and tear. Okay, so it's not that for each asset you're going to have to, in your e-filing, say this asset is an improvement, I don't meet the requirements. We assume that you've gone through that process when you've done your calculation, and you are literally just taking your answer from your calculation and slotting it into e-filing. Did I answer you?
Yes. So basically, SARS gives you the forms there, basically, and you might just fill in the form.
Yes, so SARS just gives you the form, and there's just a space where you're going to fill in the number. SARS doesn't have like little questions that say, was this new and unused? Did you buy part of a building? All that stuff has to happen here. And that's why people pay tax practitioners to do that stuff for them, because they don't know that stuff. If you're the practitioner, you know that stuff, and you're doing the calculations and all the, you know, the thought processes here on the side, and in the end you get a number, which is your wear and tear, and that's what you slot into your form.
So if that isn't in the form, you can't claim it.
Yes, if it's not in the form, you can't claim it. Okay. Right. Okay. Does that answer you now? Okay. Right. Any other questions? Okay, so that then brings us to the end of all the different capital allowances. And I now use that terminology as wear and tear because that is what we refer to. Accounting is depreciation. In tax, we refer to wear and tear. It's just different terminology. That is the end of all the sections that we have for wear and tear on the assets. Okay. Now we're just going to step into a little bit of a different side of looking at assets. And we're going to be looking at what happens if we have assets that are leased out. Okay, so we're still sort of looking at things that are capital in nature, but we're looking now specifically at the lease transactions of these assets. Okay, now we could be referring to the lease of a small asset. So it could be a lease of a computer, it could be a lease of a car, it could be a lease of a building. So it doesn't matter what I'm speaking about, it could be a lease on anything. Okay? It isn't split into sections to say if you're leasing out a building, the following happens. If you're leasing out a small, if you're leasing an asset, these are the rules that apply. Okay, so that is what we're doing now in terms of leases. Right, and while we speak about leases, I am going to do those specific sections that we spoke about earlier. That first slide, we said we're going to look at what a lease premium is, leasehold improvements, and relief for the lessor. I am going to do that, but I also want to give you a much bigger picture of leases so that in your mind you understand leases both from the perspective of the lessor and the lessee. So what I'm going to do is on this side on the board, I'm going to keep a bit of a summary or a table. And on this table, I'm going to just split my page in two. And on this side, I'm going to deal with the lessor. So this is the owner of the asset, the person renting out the asset. And I'm going to deal with the lessee. Right, and I want us to have a whole picture of it. I don't just want to like zoom in on one little transaction and talk about it. If you have a lease transaction with a client, I want you to think about all the aspects of a lease. And the most obvious one for us at this point, because we've just done it, is I want you to think about the lessor who is the owner of an asset. Okay? This person owns the asset, which means there must be some kind of capital allowance on that asset. Right, so don't forget about the obvious things. The lessor has an asset which we can claim a capital allowance on. So you're going to have to figure out what asset do they have. Do they have a building? Do they have... And you're going to claim the allowance for them. So the allowances we've just done will be given to the lessor. Then I also want you to think about the most obvious thing in a lease that people tend to forget about is the rental. Okay? In the lessor's hands, there's rental income. Okay, now tell me about this income. What is the implication for tax? Does the lessor have to include it? Yes, it's gross income, and it's definitely a plus in their calculation. What about the rental expense on the lessee side? They can get a deduction, right? Meets the requirements of Section 11A, okay? It's amounts actually incurred in the production of income, okay, as long as they're using it in their trade, okay? And so in their hands, there's a minus. Okay, now this might seem obvious to you that I'm telling you these things up front, but in my experience, especially with students answering a paper, they get so involved in a lease transaction and the difficult parts about it that they forget the obvious things, that there's an underlying asset that we must claim allowances on, and there's rental income or expense depending in whose hands we're looking. Right, so don't forget the big picture of what is going on. Yes, there are some extra things that we need to deal with when it comes to leases, but don't forget the easy stuff, okay? These things are important as well, and you know the rules for them. Don't forget about them. Okay, now let's add in all the funnies for leases. Okay, so those are the things that we know about and that are easy for us to remember. Okay, 3 things that I'm going to speak about now that are new sections to you. So that's stuff you know. Let's talk about the new stuff. We're going to talk about a lease premium. We're going to talk about leasehold improvements. And then we're going to talk about relief for the lessor. Those are the 3 deductions that we're going to look at today. But again, as we talk about them, I want you to think about it from both the lessor and the lessee's point of view. Okay, so let's go to our first one, which is a lease premium. And this deduction, section 11F, is for the lessee. Okay, but before we get to the lessee, I want you just to come back to this thing here and to tell me here, if I've got a lease premium, firstly, do you all understand what a lease premium is? Okay, a lease premium is something that is paid up front at the beginning of the contract. Now, people often confuse a deposit paid up front at the beginning of a contract. It's not the deposit that's paid. A lease premium is something extra that's paid. It's this upfront cash amount that's paid to secure a lease. And it's usually paid on assets that are quite difficult to acquire. So, for example, in our commercial shopping space, in a centre, let's say at the waterfront at Cape Town, where people are fighting about getting a position to have a shop there, you might have to pay a lease premium up front to secure the lease. Right, so it's an extra amount that is paid up front from the lessee to the lessor to secure a lease. It's not the deposit. The deposit is not taxable because what happens? Deposit paid to lessor, just holds it, it's not his to spend, has to give it back to the lessee at the end of the contract. Okay, so that's very different from the lease premium. Lease premium is paid and it's the lessor's to keep. Right, now tell me about this lease premium in the lessor's hands, because you know what this is, you've learned this. The lessor is receiving money up front in their hands. Do they have to include it into their gross income? Yes, okay. They definitely have to include it into their gross income, and it's not even a guessing game. It's a specific inclusion in terms of paragraph G of our gross income definition. Okay, it tells us, lessor, include the lease premium, it's a plus in their hands, and that's how it is. Okay, so if the lease premium is 50,000 Rand, the lessor will include 50,000 Rand in their hands. Okay. So today, we're now looking in the hands of the lessee, and we're trying to decide if the lessee can get a deduction under section 11F. Okay, so we are looking at it from the lessee's point of view. And the answer is yes, the lessee can get a deduction. Because remember, what we're trying to do in our legislation is we're always trying to match pluses and minuses. And SARS is happy to give someone a deduction if they've received a plus somewhere else. So someone else has been taxed on it, therefore someone can get a deduction on it. Okay, if you understand that, then the rules that are written into our legislation make so much more sense. Because SARS is happy to give if they could take from someone else in the same transaction. Okay, so it's already been included in the income of the lessor, so the lessee can get a deduction. But the lessee's deduction is going to be spread over a period of time, so they're not going to be able to claim it immediately. And we're going to claim this deduction over the period of the lease. So if the lease is for 5 years, we're going to take the lease premium divided by 5. If it is paid, if the lease period of 10 years, we're going to divide it by 10 years. Right, now sometimes in a contract, it will say something like this is for a period of 2 years with the right to renew it for a further 2 years. Okay, if there's that renewal period that you're allowed to renew it for, that time will be included into this calculation. So in a contract like that, we'll say 2 years plus the right to renew for another 2 years. That gives me 4 years. I'm going to write this lease premium off over 4 years. Okay. So we're going to look at the life of the lease, and we're going to write it off over that time. Okay. You'll see here that we say that you will write it off over a maximum of 25 years. So generally speaking, our leases are not for that period of time. But if we're dealing with like a 99-year lease or something that goes above 25 years, we're going to limit this calculation to 25. Okay, so 25 is the maximum number of years that we will write it off over. Obviously, from the lessee's point of view, they want to write it off over a fewer number of years because it means they get their deduction quicker. Okay. Now, you'll remember that in capital allowances, our general rule was that we do not apportion. Okay. When we are in leases, our general rule is that we do apportion. So you're going to see with our lease transactions, we're always going to apportion. Right, so we're going to say the lease premium divided by the number of years, and then we're going to multiply by the number of months over 12 that lease was active in this year of assessment. Okay, so apportionment is going to be the general rule for us now. Okay, here's a requirement. It says the premium must have been included in the gross income of the lessor for us to get that deduction. Okay, so what is SARS saying? I'm happy to give you the minus as long as there was a plus here. Right, so generally speaking, because it's a special inclusion, the lessor would have included it. They would only not have included it if they are some kind of public benefit organization or an entity that is tax or that does not pay tax. Right. But 99.9% of the time, the lessor would have included it into their gross income, which means the lessor can get it. Right. How are we going to work it out? Well, we've said we're going to take the amount of the lease premium. We're going to divide it by the number of years of the contract. Okay, and just remember this number of years, we're going to say must be less than or equal to 25 years. Okay, so we never want more than 25 years. Okay, and then we're going to apportion it. So we're going to figure out how many months in this year was the lease running. Okay, so apportionment is going to apply. Right, and that is going to give us a deduction for the lessee. Okay, so there's a minus in their hands. Okay, is everyone comfortable with that? Right, let's quickly have a look at an example and let's see if you are happy with it. Okay, so let me just repeat the question for those of you that didn't hear it. The question was this lease premium that I pay up front. What happens if, let's say the contract was for a period of 5 years. So it's paid from the lessee to the lessor. After a period of 2 years, I decide I no longer want to be here, so I get out of the contract. Am I going to get this lease premium back? No. Okay, so that is where it's very different. A deposit, if it had been a deposit, the answer would be yes, because if I pay a deposit, I get my deposit back. A lease premium is something that I pay up front and I'm never going to get it back, which is exactly why we want to tax this guy on it, because he's received it. He can use it. He can do with whatever he wants to with it because he'll never have to pay it back to me. Okay, does that answer your question? Right, so it's never paid back to the lessee. It's the lessors to use and to do whatever they want to with it, which is why we tax them on it in the first place. Okay. Right, let's have a look at this example. We've got Tommy, okay, so sole proprietor who is renting something now for trade, okay, pays a lease premium of 25,000 Rand on 31 August 2018. Okay, let's just take a step back. We're dealing with the sole proprietor, so the year of assessment is 28 Feb. The lease will end on 31 August 2028. Okay, so it's a 10-year lease that we're dealing with. How much will Tommy be able to deduct in the 2019 year of assessment and in the 2020 year of assessment? Okay. So let's quickly look at our calculation. Okay, so we're busy with section 11F. Right, the lease premium, firstly, let's look at it from the hands of the lessor. How much is the lessor going to include in their gross income? 25, immediately, hey? Full 25 in their income, that's the end of it. Right, what is it going to be in Tommy's hands? Okay, well, there's a lease premium. Let's start with the 2019 year of assessment. There's a lease premium of 25,000 Rand paid. Okay, we need to divide that by the length of the lease, which was 10 years. Okay, we always just check that it's not more than 25. If so, we limit it to 25. Okay, for how many months did that contract run in the current year? 6 months. Okay, so from September to February. So in this year, we're going to say multiply by 6 over 12. And so if we work it out, our section 11F deduction, sorry, I thought I wrote something wrong. Our section 11F deduction will be 1,250 Rand in that first year of assessment. Okay. Now, in the next year of assessment, it becomes very easy because now, and for the next couple of years going forward, the lease is going to be happening for the full year. So we're simply going to say the 25,000 Rand divided by 10. We don't need to apportion it because the lease is running for the full year of assessment. Okay? Which means that our deduction for every year for the next 9 years will be 2,500 Rand. And then in the final year, we're going to apportion it again because in the final year, it will only run for 6 months. So it ran 6 months, then 9 full years, and then 6 months. So for the 9 years in between, we're going to claim 2,500 Rand. Okay, so that is how Section 11F works. Lessor taxed on it immediately. Lessee gets the deduction over the life. Okay, so SARS is nice. SARS is going to give us a deduction, but they're going to spread it over the life of the lease. Claim everything up front from the lessor, but the lessee claims it over the life of the lease. Right. Okay, let's just have a look at another quick example here. Okay, it's also with a lease premium. So we've got Tebi manufacturers here. They entered into a lease. Okay. On 1 May 2018 to lease an admin building for 15 years from that date. In terms of the lease agreement, Tebi must pay a lease premium of 60,000 Rand before 31 May 2018 and a monthly rental of 6,000 Rand from 1 May. Okay, we tell you that the year of assessment is February 2019. Okay, I just want to speak about the lessor quickly. The lessor firstly has an asset. Okay? If it was new and unused, they would be able to claim a Section 13 Quin allowance on it. It's a commercial building. Right. And they would be receiving a monthly rental, which they would include. And they are receiving a lease premium of, where's our lease premium? Of 60,000 Rand, which they would include. Okay, so just from the lessor's point of view, that's what would be happening. Let's look at it from the hands of Tebi manufacturers. Okay. Firstly, the most obvious thing is the rental that they're paying. Okay, and they're paying it for 10 months in this year of assessment. 6,000 Rand per month, rental, normal Section 11A deduction. They will be able to claim the 60,000 Rand as a deduction. Right. Then in terms of the lease premium. Right, in the question we were told that the lease is for a period of 15 years. So we take the lease premium of 60,000 Rand, divide it by 15 years, and then multiply it by the number of months, apportion it for the number of months the lease was active in the year, which was 10 months out of the 12 months. Right, so the lessee gets 2 deductions here. Firstly, the rental that they're paying, and secondly, a portion of this lease premium that they paid. Okay, and it's going to look like that for every year for the next 15 years. There'll be rental that they pay, and they get a portion of the lease premium. Okay, is everyone comfortable with this? Okay. So that is lease premiums. What happens now if we speak about leasehold improvements? Okay, so now we're adding leasehold improvements. Okay, Okay, so firstly, just to check that we all understand what leasehold improvements are. Leasehold improvements means that the lessee is making some kind of improvement to the assets of the lessor. And it would usually happen because the specific asset that we're renting doesn't meet all our requirements. So I might be renting a building from a lessor, but in that building, I need some extra requirements. So maybe I am going to bake in that building and I need to create a kitchen which can deal with my baking needs. So I change the building, there's improvements made, and I add the things in that I would need to bake in. So I build in an extra section, put up walls, put the place where the ovens are going to go in. I make an improvement to the building. Is that building mine? I'm the lessee. No, it's still the lessor's. And what's going to happen at the end of the contract? Am I going to rip out the walls and take them with me? Well, there'd be no point. Okay, so what's going to happen at the end of the contract is those leasehold improvements are going to pass to the lessor and they're going to have the benefits of it. Right, so that is generally what will happen when we're talking about leasehold improvements. And again, you know what the implication is in terms of the lessor. What is the implication? Okay, gross income. Okay, definitely. And again, it's not a guessing game. Gross income, we have a specific inclusion in terms of paragraph H that says the lessor is going to include it into their gross income. Right, now we're going to speak about some relief that the lessor gets for that leasehold improvement. But for now, there's a specific inclusion. And again, when there's an inclusion, SARS is happy to give a deduction to the other party. Right, and that's where we stand today. We're standing on the other side of the equation, and we're trying to see if there will be a deduction for the lessee. Okay, I'm going to come back to this one just now because there is a little bit of relief for the lessor. Okay. However, let's first go and look at the deduction from the lessee's point of view. And now we're under section 11G, and we're trying to get a minus for the lessee. Right, now section 11G will be applicable firstly if there is a leasehold improvement that has been incurred. Obviously there must be some kind of cost incurred, otherwise there's not going to be a deduction. Okay, and then secondly, the lessor must have included it into their income. So we want this inclusion in terms of paragraph H. And again, 99.9% of the time, the lessor would have included it into their income. Right, if they're a PBO or someone who doesn't pay tax, then we would not have that inclusion. Right, but most of the time we would have the inclusion, which means we get the deduction. Okay, and again, this is very similar in terms of our lease premium. We are going to get a deduction over the period of the lease. Okay, but the difficult thing here is we are not going to get it over the whole period of the lease. We are going to get it over the period of the lease that remains after these improvements are brought into use. Because sometimes we'll start renting this building or this asset, whatever it is, and we start creating the improvement. And it might take us 5-6 months to get this thing ready for us to start using. And at that point where it's ready to use and we start using, we're going to say how much of this lease contract is left. And that is how we're going to determine how much or over how much time we are going to write it off. Okay, so again, we're going to take the amount, and I'm going to speak about this amount in a second, but we're going to divide it by the number of years, but the number of years that are remaining. Okay, so not the number of years of the contract, the number of years remaining on the contract. And then again, we are going to apportion it. And this apportionment is going to happen for the number of months that we started using that improvement. So if the improvement is finished and I can use it for 2 months in the year, I'm going to say times 2 over 12. Right, so this apportionment happens from the day that it is brought into use. Okay. Again, that 25-year rule applies as well. So when we're speaking about the number of years, we never want to divided by more than 25 years. That is going to be the maximum number of years that we divide it by. Okay, so that is how our leasehold calculation is going to work. Right, so very similar to lease premium. I think the only tricky thing is this remaining life. The other tricky thing that comes into play is this thing, the value of the asset. Okay, so what are we talking about when we speak about the value of the asset? Okay, firstly, we're speaking about the cost that's been incurred. So there must actually be some kind of cost that is incurred. So we're looking at the actual cost, but we're also looking at what we were told to spend contractually. Now, usually these things are the same. Right, so what I'm asking on the next slide is I'm saying, what is the cost of the improvement? What is it that we're going to use in that rand value? Okay, and we want to use what has actually been incurred. However, we're going to go back to the contractual value and we're going to limit it to the contractual value. Now, it's usually the same thing because let's say, for example, in my example of creating this kitchen for my bakery, I would sit down with my lessor and I say, these are the improvements I want to make to your building. Am I allowed to make them? Here are the quotes I've received to make them. This is what it's going to cost me. This is exactly what I'm going to do. I'm going to build a wall here. This is what I'm going to do. It's going to tell the lessor exactly what I'm going to do in their building. Right, and they're going to agree on it. And in this contract, it's going to say, here's a quote, it's going to cost me 1 million rand to do this. So if the quote says it's 1 million rand, my cost is probably going to be 1 million rand. Right. However, what if the contract said it must be 1 million rand? Okay. Now, the cost of materials went down in the time that I did it, and when I physically have to pay the amount, I pay 980,000 rand. What do you think this deduction is going to be based on? 980. Yeah, because ISA's ever going to give me more than I spent. They're nice, but they're not that nice. Okay. So yes, it's going to be based on what I actually spent. What happens if I spend more than the contract? Contract value. Yeah. So if I spend more money, sorry for me, I spent more money. My deduction is going to be based on the contract value. Because what is that guy going to be taxed on? Contract value. So is SARS suddenly going to want to give me an extra deduction? I don't think so. Right, now generally speaking, what we spend and what is in the contract would be very accurate because we get quotes. It's not just a thumb suck of a figure. So if I'm spending more money, it's really my own problem. Okay, so what will happen in a situation like that? Let's draw a little picture quickly. Sorry, I'm just numbering these so I remember how to put them up on ClickUp for you. Okay, let's do a little example quickly. Let's say, for argument's sake, that in the contract we had to do some kind of improvements. Okay, and the contract stipulated that it must be 1 million rand. Okay, so this is what the contract said. Right, we already did the first scenario where we said, well, if I now actually spend less, it will be based on what was actually incurred. Okay. However, what happens if I spend more? Well, then 11F says you can only claim it based on, let me just use a darker color. You can only claim it based on what the contract said. So you can only claim it on the 1 million rand. Okay, so 11G, we're going to use the 1 million rand. What about this extra 200,000 rand that I spent? Is there a deduction for me? I actually incurred it. Okay, can I get a deduction under 11A? What nature is this improvement? It's capital in nature, right? So even though I actually incurred it, unfortunately, because it's capital in nature, I will get no deduction. Okay, because think about it, it's capital in nature, so can I go to my capital allowance sections? Am I the owner of this asset? No, I have incurred it, but I'm not the owner of it. So will I be able to claim any of the allowances? Okay, so remember, there was one section where I said you didn't have to be the owner. Which was that? Section 13. So that's an interesting one. Section 13 doesn't speak about that ownership requirement. So what happens if this improvement is a Section 13 asset? I'm not the owner, but that's okay. I don't have to be. Right. If it is a Section 13 asset, I'm going to claim the R1,000,000 under 11G, and this excess portion I will be able to claim under Section 13. Even though I'm not the owner, I actually incurred it, and I can claim the excess there. Right, but that's a really special rule, because if it's any other asset, all my other assets say to me that I need to be the owner. So if it's any other asset, I lose the deduction. Okay, so that's a real funny one. When we talk about leasehold improvements, if there's an excess, and if the excess is on a Section 13 building, then I can claim the excess even if I'm not the owner. But all other times, the excess falls away and I get no deduction. Okay, so this is a real exception to the rule kind of part. The general rule is you lose the excess, there's no deduction. Okay, the exception to the rule is if it is a Section 13 asset. Okay, so just remember the excess falls away, there's no deduction. We only claim the value of the contract under 11G. The only time you would get the excess is if it happened to be a Section 13 asset. Right. Okay, but for now, we're just dealing with Section 11G now, and 11G is going to make us claim it just on that R1,000,000. So that is how we're going to do our calculations for 11G. Let's quickly have a look at an example together. Right. So we've got a taxpayer here. They enter into an agreement on the 1st of July 2016. The lessee paid a premium of 120. Okay, so there's a lease premium right up front here. And the agreement was granted for the use of land. Okay, so we just at this point are paying for land. The lessee had an obligation to effect improvements, an office block. Okay, so an office block on the land to the value of 24 million rand. And the value of the improvements will constitute income for the person to whom has the rights of the improvements. The office block was completed at a cost of 28 million rand, so above the cost of the value of the contract. And it was brought into use on the 1st of June 2018. So you can see 2 years have passed here. Okay, now here comes a big spanner in the works. The lessee only started trading. Okay, remember trade is key to all our deductions. The lessee only started trading on that day, in other words, 1 June 2018. Okay, so what do we know about pre-trade? Section 11 Cap A is our pre-trade expenditure thing, and it says you can keep track of all those expenses that you would have claimed if you had been trading, and at the point where you start trading, you can claim them. Right, so that's going to be the situation here. Now I want to give you 5 minutes. I don't want you to do all the calculations and everything. All I want you to do is draw a little picture for yourself, figure out where we're going to claim things, when we're going to start claiming, figure out how long the term of the contract is, by how many years are we going to divide this lease premium, by how many years are we going to divide the leasehold improvements. Okay, I'm going to give you 5 minutes just to get a picture for yourself of how we're going to start this calculation. Okay, so again, I've drawn myself a bit of a picture. We've got the lease premium paid here on the 1st of July 2016. Okay, and then I've put in my year of assessment, 28 Feb, 17, 18, and 19. Okay. Then I also have this leasehold improvement that happens here on the 1st of June, okay, 2018. And it also is the date that I start trading. Okay, and then I just split my things here because I know I apportion. So in this first year, the lease premium was paid, and then there's 8 out of 12 months that's left over here from July to Feb. There's a full year here. And then although this is a full year, I've just split it between pre-trade, before I trade, and post-trade. So 3 months and 9 months. Okay, so that's just the picture that I drew for myself. Let's quickly have a look at what we're going to do. Let's start with the lease premium. It is 120,000 Rand. The issue for us is we're going to say that 120,000 Rand divided by the period of the lease, which is 30 years, so we're going to limit it to 25. Okay, and I am going to work it out for each of these years, but can I claim it here yet? When am I going to claim it? When I start trading. Okay, so when I look at my calculation of my lease premium, I'm going to work it out. So for the 2017 year of assessment, I would have said 120 divided by 25, but I would only get it for 8 out of the 12 months. Okay, and although the calculation is under Section 11G, I'm now claiming it in the current year of assessment as a pre-trade expenditure under Section 11 Cap A. Okay, I couldn't claim it in those prior years, I wasn't trading yet. Okay, but I don't lose the deduction, I just keep track of it, and in the year that I start trading, I claim it immediately. If I had been trading, I would have been able to claim it in 2018. I would have simply said the 120,000 divided by the 25. Okay, and in 2019, I would obviously be able to claim it for the full year. Okay, now I've just simply split it. It's a very technical split. I'm getting the deduction for the whole year. But for the first 3 months of the year, I'm getting it as a pre-trade expenditure because for the first 3 months, I'm not trading. Okay. Can you see here that essentially for 2019, I'm going to get the full 4,800 Rand for a full year. Okay. But I'm splitting it and I'm saying for the first 3 months, I'm claiming it under Section 11 Cap A, pre-trade expenditure. And for the last 9 months, I'm claiming it under 11F. Right, and now for the rest of time, I can claim it under 11F because I am now trading. So spread over a period of 25 years, I will claim the full 120,000 Rand. Okay, so that one just was a little bit funny because we hadn't been trading, and so we claimed all those previous years in the current year when we started trading. Okay. Let's speak about the leasehold improvement. Leasehold improvement happened here on the 1st of June. We had the leasehold improvement. Let's quickly speak about the value of the leasehold improvement. Contract said 24 million. We spent 28 million. Okay, now we know we can only look at the contract value. Tell me about the excess. Is there anything available? Okay, is Section 13 applicable in this situation? Is it a manufacturing? It's an office building, okay? Definitely can't go and claim 13 Quin. 13 Quin says you must be the owner. Right, so the excess of 4 million Rand simply falls away. Okay, we can't ever claim it. Right, so we're only going to claim Section 11G on the 24 million, and the 4 million Rand excess falls away. Okay, so the 24 million, we're going to write off over what is left on the lease. Okay, now let's first go work out what is left on the lease. Well, if 1 year and 11 months had passed, because that is what had happened, if you add up this, 1 year and 11 months had passed of the contract, it means, if it was a 30-year contract, 28 years and, am I getting myself confused now? Yes, 1 year and 11 months had passed. So what was left on the contract is 28 years and 1 month. Right, so we would technically be dividing it by 28 years and 1 month, but we have to limit it to 25. Right, so I don't want you to get confused. It's not just that we're dividing it by 25. We first check what's remaining, and then if what is remaining is more than 25, we divide by the 25. Okay, so that's why we're dividing by 25. The leasehold improvements were in use for 9 months in the year, so we apportion by the 9 months, and so our 11G deduction is 720,000. Again, the excess of 4 million simply falls away. Okay, are you all happy with that? Right. Okay, so that then brings us to the end of our leasehold improvements. So if we go back to this little summary that we've been keeping of our lessor and our lessee, we've dealt with the deduction for the lease premium and the leasehold improvement. Now we just want to speak about relief that we give to the lessor. Okay, and let's just speak about why the lessor needs relief. If you look at this inclusion here, this lessor, let's just use the previous example. The lessee put up leasehold improvements of 24 million rand. When those leasehold improvements are put up, that lessor has to put that full 24 million rand into their gross income. When are they going to receive the benefits of it? After 30 years, when the contract is finished. So is it really fair that they get taxed on that full 24 million? No, it's not fair, because when they receive it, it won't be worth 24 million rand anymore. Okay, so that is what Section 11H does. It says, yes, put the full amount in gross income, but then we're going to give this lessor some relief under Section 11H. And we're going to give them a deduction under Section 11H. So they include the full amount into gross income, but then they get a deduction under Section 11H. And the net effect is that what is included into income is the present value or the current value of what they're receiving. Now, by present value, we mean we take the time value of money into account. And we say the Act uses 6% per year. If we're using a rate of 6% per year and we look at it over a period of 30 years, the value that it's worth today in terms of taking the time value of money into account, that is what we want to tax you on. Okay, so how do we work this out? Well, we work out what the present value is, okay, using 6% per annum. Now, we're not going to expect you to do that calculation. We have experts that do those calculations for us. So in a question, in a test, in an assignment, we will just say to you, the present value is, and we'll give it to you. Right, can you then see that this deduction becomes my balancing figure? Because if I had told you that the leasehold improvements were R1 million, and I told you that the present value was 800,000 rand, how much would my deduction be? 200,000. Okay, so in a test, that's what you're going to do. The gross amount is going to be included into gross income, and you're going to work out what the deduction is based on the present value. Right, so it will always be the balancing figure. The result is that this lessor is taxed on the present value of what they will receive. Okay, so it's just some kind of relief for the lessor. Right, so that's how Section 11H works. It's actually very simple. We will give you, either we will say the Section 11H deduction is and give you the deduction amount, or probably more likely is we'll say the present value of this is equal to 800,000 rand. And then you must just work out what the deduction is. Right, so let's just do a very brief example to make sure that we understand. Okay, we've got Bertus. He's got an agreement with his lessee. So Bertus is the lessor. Okay. The lessee needs to make improvements. The improvements were completed on 30 November 2018. Okay, we're dealing with sole traders, so 28 Feb year end. Okay, and the agreed amount of the improvements was 2 million rand. Brought into use on 1 December. The lease was signed on 1 January 2016 for 20 years. Okay, the present value of the improvement is 1,650. Let's quickly just deal with the lessor. Okay, we're going to look at it from the lessor and the lessee's point of view. Lessor, what is the inclusion into gross income? The 2 million. Right. We tell you that present value is 650,000 rand. So what is the relief under 11H? 350,000. Okay, so if I go to my solution here, the lessor includes the 2 million. Okay, paragraph H, special inclusion. But then they get a Section 11H deduction of 350,000. The net effect is that the 2 million minus the 350 equals 1,650,000, which means that they get taxed on the present value. Okay, as simple as that. That is how the Section 11H relief works. Let's speak about it from the hands of the lessee. Now this one gets a little bit more difficult because the lessee, let's just go back to the facts of this question. And let's just draw ourselves a little picture here of what is happening. If we've got a timeline here, okay, we've got the lessee who made the improvements. They were completed on 30 November 2018. So let's just put a thing in here, 30 November 2018. Right. The lease contract started on 1 January 2016. And it was for a period of 20 years. Okay, so let's just keep that in mind, 20 years. So if we go and put in our years of assessment here, we already had a year of assessment here. Oopsie, I need to put in 2. So we've got February 2016, February 2017, actually another one, February 2018. Okay, and now we are at February 2019. Right, now this thing started and 20 years, it was for 20 years. Now the leasehold improvements happened here at this point, 30 November 2018. For the lessee, we need to figure out how many years are left. Now how many years are left? Because the lease started January, so think about it, it ran January to December 2016, 2017, and then it ran up to 30 November 2018. So it ran for a period of 2 years and 11 months. You must just check me, hey? All right. So if it ran for a period of 2 years and 11 months, how many years are left? Okay, yes. So what is left on this? 17 years and 1 month. Okay, sure. Now this makes our calculation a little bit tricky. 17 years and 1 month. How on earth are we going to do this? Okay. So there are 2 ways that you can do it because we need to divide it by the remaining period of the lease. Right, now you'll see the way that we've done it here at the bottom. We've said, well, what is 17 years and 1 month? 17 times 12, okay, gives you 204 months, plus the 1 month gives you 205 months. So I've converted it to a monthly thing, and I've said the 2 million rand divided by 205 months, okay, will give me what the monthly amount is that I can claim. But now be careful, now I'm multiplying it by 3 and not 3 over 12 because I am now working with monthly figures. Right, so that is the one way to do it when we are working out the remaining period. The other way that you could have done it is you could have worked out what this fraction is. And if you work out what this fraction is, it is 17.083333 recurring. Okay, so you could have also said the value of this improvement, which is 2 million rand, if you still wanted to work in years, you could say divided by 17.083333 and then times by, how we would normally do it, times by 3 over 12. Right, so 2 different options in the way that you can calculate it. Either you can convert it to a monthly calculation, but be careful then you are multiplying by months. Or you can keep it in years, work out what the yearly fraction is, and then multiply by 3 over 12. Okay. Now, we're not going to go into any more detail into days and things like that. We will keep it at full months. And either way that you do your calculation would be correct, either converting it to months or keeping it as a yearly calculation. It's going to give you exactly the same answer, and you would end up with this 29,268, which is the deduction. Okay, so again, the trick here for the lessee is working out the remaining period. And that's why I said to you, these things don't happen in full years. It's not just going to be 6 years that's left. It's going to be 6 years and 2 months or 6 years and 5 months. So either convert it to a monthly calculation or keep it as an annual calculation and use the decimal places. Okay, is everyone comfortable with how we do that leasehold improvements? Okay. Are you still alive and well? Should we have a break? I think so. Okay. It is almost 5 past on my watch. Is 15 minutes long enough, or do you need 20 minutes? Okay, right, ladies and gentlemen, let's start again. So we're still busy with our last bit of capital allowances. What's going to happen in the rest of this lecture now is I'm going to start looking at what happens when we sell our capital assets. Okay, so we're going to focus on recoupments and scrapping allowances. Okay, so the profits or losses we might make on the sale. And then we're also going to start looking at the very brief introduction of CGT. Okay, in our next lecture on the 18th, we'll look at CGT in a little bit more detail. Okay, but CGT we do on a very high level on this course. But for today, I just want us to draw the picture together that when we dispose of an asset, there could be a recoupment, there could be a scrapping allowance, and there could be CGT. So we need to just keep that in mind. That's why I just wanted to start with CGT today, because it does really link to what we're doing, and it doesn't happen in isolation of each other. All right, so that's why we're going to just start with the very basics of CGT today. Okay, but before we get into the disposals and before we get into recoupments and scrapping allowances, I wanted to just check that we all are on track with what we are doing. So this is just a recap. It's not that we're going to physically do the questions. Let's just see if what we've spoken about today, if you understand it thus far, and then we can move forward. Okay, so we have Jones, who's a sole proprietor. He's got a trade, and he's got all the following assets that he has brought into use, and he started using all of the assets on the 1st of February 2019. Okay, so we're looking at his 2019 year of assessment. He's not a VAT vendor, so we're just going to ignore VAT in this question, and let's look at the different assets he has. He's got a new and unused manufacturing machine. All I want to know is what rate are we going to use? 40%. Do we apportion it? No. Okay, so it's going to be a straight 200,000 times 40%. Okay, what about this? He's got a second-hand manufacturing machine for 150. 20%. Do we apportion? No. Okay, good. A flat in Hatfield for 650,000 Rand, which he leases out for additional income. Okay, obviously the income is going to be in his hands, but let's speak about the flat. Is there a deduction for him? Okay, it's a residential unit. Residential units fall under 13.6. Is 13.6 applicable? How many units does he have? 1. And he needs 5. Okay, so there's no deduction for him for the flat. There's no capital allowance. Right. Okay, office space. So he has an office that he's using. It's the 3rd floor of a 3-story building, 980,000 Rand. He bought it directly from the developer. Office space, commercial building, 13 quin. Is it applicable? Is it a new and unused building? Yes. Okay. What do we need to do? What do we need to do first? Because he's buying part of a building. Good. Multiply by the 55%, and then we can apply the 5% that we use on buildings. Okay, good. Okay, last one. A computer that he uses in his trade, purchased it for 6,700 Rand. Okay, good. So it falls under section 11E, our fallback section, but it's under 7,000 Rand, so he claims the whole amount in this year. If I had changed that last scenario and I'd made this a computer for 20,000 Rand, we would have had to go and look over how many years computers get written off. We would divide by the number of years, and then we would multiply, because remember 11E is the only one that we apportion, multiply by 1 over 12 months. Okay, but because it was less than 7,000, we claim it immediately. Good. I know you've been listening. It makes me feel a bit better. Okay, right. Okay, so on this next slide, I've just got something for you that you can use or not use. Okay, it's not something we're going to do in class, but for me, this is the way that I would study capital allowances. This is just a summary of all the different sections that we have done. Okay, and then we've got columns there to say cost, what is the rate, do we apportion, do we not? And in this, I would put, because remember, there's a whole lot of things that I've said are common rules. So like all our assets, we don't apportion except for 11E. So fill in this table based on what we've studied. And then what I would do is I would highlight the exceptions. Right, because then if I'm studying it or I'm trying to figure out and learn these things, I can see, okay, the general rule is that I always use the lower of cost or market value, except for 11E where I use value, and except for section 13 where we just use cost, okay? Or I don't ever apportion except if I'm in 11E, or except if I'm in my lease transactions. Now, if you do it like that, it's all in one place. So on one page, you can have a summary of everything. And in the other column, you might want to write things like under 13 quin and under 13 sex. You might want to write something about 55% if it's part of a building, 30% if it's an improvement. Okay, just for me, it helps me to understand it if I can see it all in one place, and I somehow have highlighted the exceptions, because then it's easy to study general rule and then the exceptions stand out for you. Okay, like where do you have to be an owner? Everywhere you're an owner except section 13. Okay, so this is just maybe something you'd like to use for yourself to summarize what we've done in class today. Okay. Right, so now we're getting on to what I said we're going to be doing is our recoupments and our scrapping allowances. Okay, and what we're going to be doing in this section is we're saying if we have an asset that we've been writing off in terms of our capital allowance section, when we sell it, just like accounting, where you either make an accounting profit or an accounting loss, you are either going to make a tax profit or a tax loss based on the tax value. Okay, now what is the tax value? Tax value is the cost of the asset minus all the allowances that you've been able to claim on the asset. Okay, so we're going to look at, so accounting, you would look at the book value of the asset. For tax, we look at the tax value. Right, and then we look at how much we're selling the asset for. And if we are selling it for more than the tax value, we're making a profit. Okay, and whenever we're making a profit, SARS wants to tax us. And that profit we're going to call a recoupment. And the recoupment is going to be a special inclusion. Okay, so we're going to include it with our special inclusions. If I'm making a loss, it's going to be a scrapping allowance, which is a special deduction. So the profit is going to be a plus in our tax calculation. Scrapping allowance is going to be a minus. Right, so that's where we are for now. So if we are in our framework, if you end up with a recoupment, you're going to put it in on this line, okay, add it in as a special inclusion. If you end up with a section 11.0 scrapping allowance, it's going to fall under here, under our specific deductions. Right, so let's just think about this now. How exactly is this going to work? Right, now before I get into this example, let me just speak about this thing that I'm calling a recoupment, which is our profit. What is a recoupment? A recoupment is SARS taking back the allowances that they gave you. Okay, so it's recouping or taking back the allowances that they gave you. Right, so we're going to look at that asset and look over the years what allowances you claimed on the asset. If you are then making a profit on the asset, it makes sense that SARS wants to take back those allowances. So the way that they do it is through a recoupment. And essentially, they are reversing the allowances that we have claimed before. That is what a recoupment is. Okay, so do you think it would be fair for SARS to take back more than what they had given you? No. Okay, so a recoupment can never be more than the allowances that you were given. Right. Okay, let's leave it at that for now. Right, I'm going to add on to that just now when we get to CGT. But for now, for a recoupment, SARS cannot recoup more than you were given as an allowance. Okay, and I'm going to show you how we make sure that that never happens. So we have a little scenario here, and we have a manufacturing machine which was used. It was purchased on 30 November 2017. We've got a sole proprietorship, so 28 Feb year end. 100,000 Rand, new and unused, and it was sold on the 1st of February 2019. Okay, and then we're going to give you a couple of scenarios there. So let's quickly work out how many allowances we have had on this asset already. Okay, we know that the cost of the asset, they've told us it was a new and unused machine which they purchased for 100,000 Rand. Okay. And it was purchased on 30 November 2017. So the first time we would have got an allowance is 28 Feb 2018. Okay, and what percentage would we have gotten there? Manufacturing machine, new and unused? 40%. So we would have got 100,000 Rand times by 40%. So in the 2018 year of assessment, we would have claimed 40,000 Rand. Okay, in the 2019 year of assessment is when we sell it. But we can still claim in that year because we still used it in that year. Remember, whenever we're claiming an allowance, it's based on the use. Now, even though we sold it halfway through, not halfway through, but during this next year of assessment, we can still claim our allowance in this year because during the 2019 year of assessment, we still used the asset. Right. So we sold it on 1 February, but we can still claim it. What percentage will we use in this year? 20%. Okay, we don't have to apportion it, right, because it's 12C, which means we would have claimed 20,000. Okay. If it had been an 11E asset, we would have claimed it up until the day that we sold it. Okay, because remember 11E apportions for use. So where we were looking before of apportionment at the beginning of the asset, the end of the life of the asset is also apportioned for the period of use up to the point where we sell it, if it's an 11E asset. Okay, but 12C we don't apportion. So very straightforward, but that is the end of the allowances that we will get. Okay, so you can see here that the allowances that we have claimed here equals an amount of 60,000 Rand. Okay, so that is the maximum amount that SARS will be able to recoup from us. Okay, that's the maximum amount. They cannot recoup more. Okay, now we want to work out what we refer to as our tax value. Tax value is the cost of the asset minus all the allowances we've claimed over the years. So the tax value of this asset is 40,000 Rand. Okay, now this is the thing that we're going to use to calculate if we've made a profit or a loss. Right, now let's look at the scenarios here. First scenario, A. I sell this asset for 90,000 Rand. Okay, have I made a profit or a loss? What's the tax value of the asset now? 40. So if I'm basing it on the tax value, okay, so don't go back to looking at the cost. If I'm basing it on the tax value, what that asset is worth now. If I think it's worth 40,000 and I sell it for 90, have I made a profit or a loss? Profit. Okay, so the 90 minus the 40 gives me a 50,000 Rand recoupment. Okay, is it more than the 60,000? No, so SARS can take back everything. That whole profit he can take back. Oopsie, I must be careful. I mustn't call SARS a he, hey. Gender neutral SARS can take back the 50,000 Rand. Okay, so I'm not saying SARS will take back the full 60,000 Rand. Okay, we're going to work out the actual profit, but the maximum that SARS can recoup or take back is the 60. But in this case, our profit is 50, so our recoupment is 50. Okay, let's look at my second scenario. My second scenario, my selling price is 20. So if I'm selling it for 20 and its value is 40, what am I making here? A loss. Okay, so when I make a loss, SARS is not going to take anything back from me. In fact, they're going to give me an extra deduction in certain circumstances. Okay, and we're going to look at that now. But there's a loss, and I could possibly get an extra deduction or a Section 11(0) scrapping allowance in certain scenarios. Okay, last scenario. We sell it for 130,000. Have we made a profit or loss? Okay, what is my profit there? 90,000. Okay, my profit is 90. What is the maximum that SARS can take back from me? 60. So the maximum recoupment that I'm going to have on this thing is 60,000. Okay. What about that other 30,000? Do you think SARS is just like, oh wow, I'm so happy for you that you've sold it for a huge amount. I'm just going to tax you on 60. Don't worry about the other 30. You can have it. No. Okay. When it goes above that is when we crawl into capital gains tax. Okay, so that's how capital gains tax fits into the equation. As soon as you're going above that amount of the allowances, right, we're sitting in a capital gains tax situation. And it's always going to be the case where you sell an asset for more than its original cost. Okay, what was the original cost of the asset? 100. Okay, 130, what we sold it for, minus the 100 cost, gives us that 1,000. Okay, so whenever we sell an asset above the original cost, we are in a CGT scenario. All right, and that's where we're going to go to just at the last part of today's lecture. For now, we're going to be looking at this part, at looking at the recoupments, looking at the scrapping allowances, and realizing that we limit the recoupments to what we had already claimed. But if your profit is more than that, then we are going into a CGT situation. So when your selling price is more than your cost, you are in a CGT scenario. Okay. That being said, this is the formula we get given to work out our recoupments, to make sure we never go above the allowances. It's the selling price limited to the cost price. Okay, that is how we're going to make sure that we never go above SARS recouping all our allowances. So if we had done that in this example, if we had said the selling price of 130, but limited to my cost of 100, okay, minus my tax value of 40, we would have ended up at the recoupment of 60. Okay, which we just did manually. We said all our allowances were 60, therefore the recoupment must be limited to 60. Okay, but this is the way that we make sure that we never go above that. When we're working out a recoupment or a scrapping allowance, we always say selling price limited to cost, so may not be more than cost, minus the tax value. If you end up with a positive answer, you have a recoupment, which we're going to have as a special inclusion. If you end up with a minus answer, so in other words a loss, we are in a scrapping loss situation. Right, so it's the same calculation. If it ends as a positive, as a profit, we have a recoupment. If it ends as a minus, we're sitting in a loss situation and we are under Section 11(0). Okay, so that's our recoupment section, Section 8(4)(a), which is a special inclusion, and then Section 11(0) is a loss situation. Okay, so this is what you're going to use every time, but you're going to see that firstly you need to work out the tax values. That's always going to be your starting point. Work out the tax value, and then you can work out if we're in a recoupment or a scrapping loss situation. Okay. Right, so we've already said this, 8(4)(a) is recouping, taking back the amounts that have been claimed previously. Okay, that's all that is happening. Okay, the first thing that you're going to do is work out your tax value. okay, which is what we've already explained. And then on the side here, I'm just explaining to you that if your selling price is more than your tax value, you're going to have a recoupment situation. In other words, if you're using that formula and you end in a plus answer, you are in a recoupment situation and you must include that into income. And then this, just the last thing that I explained to you, if the selling price is more than the original cost price, then we are also in a CGT scenario. Okay, so 3 things that can happen. If we sell an asset, it can either be a recoupment or a scrapping loss, and then on top of that, there could be CGT. Okay, right, we're going to speak about it a little bit more as we get into CGT. For now, let's just focus on the recoupment. Okay, so I'll give you an example here, and we've got a Section 11E asset here. So it's one that will be apportioned. Okay, it's a car purchased by the taxpayer to use in the trade. Okay, we're ignoring VAT here. The cost is 180,000 Rand. And interpretation note 47 says we're going to claim it over 5 years. Right. We know that we must apportion. The car was brought into use on 1 April 2015. Okay, so our first year of assessment, our year end is 28 Feb. Is 28 Feb 2016, 17, 18, and we are now in 2019. Okay, calculate the amount to be recouped if the asset is sold on 30 June 2018 for 200,000 or 160,000 Rand. Okay, let's just quickly do this together. So we have a motor car, 180,000 Rand. Okay. So our allowances that we're going to work out, let's just go back. We brought it into use on the 1st of April. So in that year, we used it from April up until February, which is 11 months. Okay. Which means in the first year of assessment, 180 divided by 5 times by 11 over 12. In the 2017 year of assessment, obviously no apportionment because we use it for the full year. Same for 2018, no apportionment. Again, then in 29, there's apportionment because we're only going to claim the allowance up until the point that we use that asset. Okay, so can you see apportionment is always going to kick in the year we bring it into use and then in the final year when we stop the use. Okay, right. So they told us we sold it on 30 June, so we could still claim it for March, April, May, June, 4 months in the current year. And that is why we say times 4 over 12. Right, so why are we working out the allowances for every year? Whoopsie. Okay, I'll just read this to you. It says, your PC ran into a problem. That's nice. Okay, let me just see if I can restart it quickly. I've never seen that message before. Okay, it says it's busy fixing the problem, so let's just do it on the board over here. Okay, so we had worked out all the allowances of the asset, and what I was saying is the reason that we worked it out is because we need to calculate the tax value of that specific asset. Right, so if we are working out the tax value of the asset, we are going to say the cost price of that asset, and in this case, the cost price of the asset was 180,000 Rand, yes, okay, and the allowances, if we add all of them up, so the 33,000 2016, 36,000 the next year, 36,000 the next year, and the 12,000 the next year, if we add all of that up, it gives us a total of 117,000 Rand of allowances. So over all the years, those are the allowances that we claimed. Right, so if we are working out our tax value, it will give us an amount of 63,000 Rand. And that is what we're going to base our calculation on. Okay, Now in scenario A, we said to you, what if we sold it for 200,000 Rand? Okay, we know that we can only recoup a maximum of 117,000 Rand. Okay, now how are we going to work out our 84A recoupment? We're going to say the selling price limited to cost minus the tax value. Okay, my selling price is 200,000 Rand, but what was my cost? 180,000. So I'm going to limit it to the 180,000 Rand minus my tax value of 63,000 Rand, which means in scenario A, I have a recoupment of 117,000 Rand. Okay, which you'll see here is the total amount of my allowances. Okay. What else will be applicable here? I'm selling it for 200. My original cost is 80. CGT. Right, so there's definitely going to be some kind of CGT implication on that portion that lay above the cost. Okay, because I sold it at an amount above the cost. Right, so that 20,000 Rand that lies above my cost, there's going to be some kind of CGT implication on it. Right, and we're going to have a look just now to see what that CGT implication is. Right, but let's look at the next scenario. In this one, they said to us, the asset was sold for an amount of 160,000 Rand. So we follow the same formula. 160,000 Rand selling price, limited to cost. Okay, we don't have to limit it. Minus the 63,000. Okay, so in this scenario, my recoupment will be an amount of 97,000 Rand. Okay, so that is always how we're going to work out a recoupment. Selling price, limited to cost, and then we're going to show that as our recoupment. If it ends up as a positive number. If it ends up as a negative number, we're sitting at a scrapping loss situation. Okay. Right, so if you follow that formula, you will never recoup more than you actually claimed. And you saw that in the first scenario here. The formula makes sure that it gets limited to what we actually claimed. Okay, if you understand that, that makes the formula quite easy. Okay, you don't have to study it off by heart, because if it makes sense to you, you understand why we are using that formula. Right. Okay, while I'm waiting for my computer to start up, let's just speak. Do you all have the slides in front of you for this moment? Okay. Hang on, I see some life here. Okay, no, it's just, okay. I was going to say, it's just teasing me here. You know the class has been too long when even your computer's complaining. Okay, we've not got long to go. Okay, while I'm waiting for it to start up, let's just speak about the next slide. In the next slide, it's speaking about connected persons. And it's just saying that when you are doing this calculation for connected persons, irrespective of what the asset is sold for, you will always use the market value as the selling price. Okay, why? Because let's think about it. If you and I are connected and the selling price should have been 500,000 Rand, but I sell it to you for 20,000 Rand, obviously I'm not going to have a recoupment, okay, which is great because I don't have to be taxed on it. Okay, but our rule says that for connected persons, when you are working out the recoupment, and you'll see when we are working out CGT as well, irrespective of what the selling price was, if it was more, if it was less, we ignore the actual selling price when it comes to connected persons, and we always use the market value. So the value that we would have been able to buy and sell that same asset in a normal marketplace. Okay, so connected persons, we always use the market value. Right. Let's now speak about section 11.0, which is our scrapping allowance section. Okay, now section 11.0 is simply when your formula ends in a minus. So that formula that I showed you, selling price, limited to cost, minus the tax value. If it ends in a zero, if it ends in a zero, there's nothing. Okay, if it ends in a minus, we are in a Section 11O situation. Okay, now Section 11O, you'll agree with me, is something that's actually quite generous from SARS. Right, because you've been writing off the asset and now suddenly SARS says, hang on, I'll give you an extra deduction because you're sitting in a loss situation. Okay, but let's think about why you would be sitting in a loss situation. You would be sitting in a loss situation There's nothing on my computer right now. Okay, let's just give it a moment. You would be sitting in a loss situation if something bad had happened. Okay, because why else would you be selling it for a value that's much less than what it's worth? Okay, so we usually sit in a Section 11O situation when you've had an accident and you're writing off the vehicle and you're getting a small amount of money back, where something's been damaged and you're selling it for less than what it's worth. Okay, so when you fall in Section 11O, something has probably happened to that asset, and that is the reason why you are selling it for less than it's worth. Okay, and because of that, SARS is generous enough to give us a deduction under Section 11O to say you can claim the loss of that asset under Section 11O. But it is not automatic, right? It doesn't apply to every asset that we have, okay? And it only applies in certain circumstances. Let's see. Okay, there is some life. Okay, so the first thing that I want to say about Section 11O is that it is an election section. Okay, now that means that the taxpayer can elect to use it or not to use it. Okay, so you don't automatically use it. You choose to use Section 11O or you wouldn't use it. Right, now I don't really know why you would not choose to use it, because it gives you an extra deduction. Right, now let me just explain something to you. When you sit in a loss situation with an asset, you are either going to have a Section 11O deduction or you are going to have a capital loss. Okay, when we get into CGT, it will be a capital loss. You will never have 11O and a capital loss in the same scenario. Okay, that's really, really important because people get so mixed up with this thing. They want to claim 11O and then they want to claim a capital loss. So it's one or the other. So 11O is the election section. So if you choose 11O and you claim the deduction in your taxable income, there's no capital loss. If you choose not to use 11O, then you will have a capital loss. Okay, so that's how those two speak to each other. You're going to have one or the other. So it will be Section 11O or it will be a capital loss. Right, now if you have the choice to choose 11O, you're going to choose it. Okay, it is by far the best thing for a taxpayer to get a deduction immediately. Capital losses, you'll see when we do CGT, have some limitations on them. Also, CGT is included at a specific rate, so you don't get the benefit of the full loss. Okay, so it would be more beneficial for a taxpayer to choose 11O if they could do that. Right. Yes, I've eventually got some life. Okay, sorry about that. I'm sure you probably feel the same as my computer and I do at this point. So let's just quickly get to the end of the lecture. Okay, so like I said, 11O is an election section. Okay, but Section 11O is only applicable to certain assets. And it is only available to assets that are written off over a short period of time. And you'll see here that it's not available to assets that are written off over a period of more than 10 years. Okay, so think quickly about the assets we did. Which assets are written off over more than 10 years? Buildings. Okay, immovable property is always written off over 10 for low-cost units or 20, the normal rule. So 11.0 will never be applicable to a building. So if you're selling a building and there is a loss on the building, you don't have the option of 11.0. So a building's loss will always fall under a capital loss. Because remember, it's one or the other. Right, so this is applicable to our movable assets. Section 11E, Section 12 Cap C. Right, I've listed the other sections there that it would be applicable to, but we don't do those sections on this course. Okay, those are other movable assets that you would claim it for. You will see that it is also not available if that asset has been sold to a connected person. So if you and I are connected persons and we sell an asset, number one, the rule is that we use the market value as the selling price to do our calcs. If then it ends up as a minus, so a loss, we may not, okay, the person who has sold the asset may not elect 11.0. So it is not available to connected persons at all, which means that they will then have to show it as a capital loss. Right, now when we do capital or capital gains tax, you'll see that if we have a capital loss between connected persons, that capital loss also has a limitation. It gets ring-fenced and cannot be used against other capital gains that we have in our business. Right, reason being, connected people try to manipulate the tax and manipulate transactions. That is why we have special rules for connected persons. Okay, but it applies to all our other assets. We would choose it if we could, so we're definitely going to choose to elect it whenever we can. And like I said to you, it normally means something has happened to this asset. It's been destroyed, it's been damaged, and that is why we are claiming it. Okay, so again, how do we get it? We look at that formula, cost, selling price limited to cost less the tax value, and we've ended up in a minus answer. So let's look at an example. We've got KZQ manufacturers. They purchased a second-hand machine, 100,000 Rand, 1st of January 2017. Machine was sold on the 30th of November 2018. Okay, they've got a 28 Feb year end. Okay, it was sold for 25,000 Rand. And now they give us the reason. There's a reason we're selling it for so little. The machine has become outdated. There's new technology. No one really wants this machine anymore, and now we are selling it. Okay, now we're going to calculate if there is a recoupment or a scrapping allowance on this asset. First thing we're going to do is work out the tax value. Initial cost was 100,000. Okay, you'll remember this was a second-hand machine, which we purchased 1 January 27. So 28 Feb 2017, sorry. 2018 and 2019, we're going to claim allowances. Second hand, so we're claiming 20% per year. Okay, so it's 20,000 Rand per year. I've just done it in one calc. So for 3 years, we would have claimed a total of 60,000 Rand. So the machine's tax value is 40,000 Rand. Okay, proceeds, 25,000 Rand. Proceeds limited to cost, 25,000 Rand. Minus the tax value of 40,000 Rand gives us a negative answer of 15,000 Rand. Okay, which means that Section 11.0 is applicable. Will the taxpayer elect it? Yes, I really can't understand why a taxpayer wouldn't elect it. Okay, taxpayer would elect it, which means in the 2019 year of assessment, this taxpayer is going to get their normal 12C allowance for the year, because remember, you still claim it for the year, and they're going to get a Section 11.0 allowance for the year, so their total deduction on this machine is 35,000 Rand. Okay, so it's just an extra deduction during the year. Again, be careful, not applicable on buildings, not applicable if it was between connected persons. Okay, otherwise 11.0 can be used by everyone. Okay, are you all happy with recoupments and scrapping allowances? Okay, not difficult. Okay, and they feed into the next part that we're going to be doing now. Okay, on the last slide, I just put you this question, the Cirque du Soleil. It's just a practice question that I want you to try. It's based on all the allowances and things that we've done now. I will also put the solution onto ClickUp. I'm also going to put a whole lot of other questions onto ClickUp that deal with capital allowances, and recoupments and things that we've done now that you can work through and make sure that you understand these sections correctly. Okay, it's the best way to figure out if you understand what you've learned is by doing the questions. Right. Let's go to our CGT notes. Okay, do you need a 5-minute break or must I just go? Must I just go? Let's just get this thing done, hey? Okay, let's get it over and done with. Okay, I promise this isn't going to take long. I just want to make the link, and I've actually made the link for you already, of how CGT fits in. Okay, so today I'm just doing this part 1. You will notice that when you work through the learning objectives for CGT, you will notice that I've said there, we're not going to use the textbook for CGT because CGT is very complicated. It's very detailed, and we're going to do it at a very high level. So I'm going to supply a document for you which has notes that we're going to use as our textbook. I haven't yet put it up for you because I don't want you to get confused yet. I'm going to put it up before our next lecture, right? I don't want you to go into that kind of detail yet. I want you to focus on the assignment that I'm going to give you to do. Okay? Remember, you're going to have that assignment to do. And that assignment will only be based on what I say in class today. So in other words, if you pay attention to what I'm saying now, you will be able to cover the CGT portion in that assignment. It will be a small portion, and it will just be based on what I say. Okay, so you don't need to go and do any further reading, go into any more detail. We'll leave that for the next lecture. Okay, right. Okay, so where does CGT fit into our framework? Okay, so now if you go to our framework, you'll see all the things that we've done, our income, our deductions. You'll remember you did assessed losses. That's where it falls in. And just after assessed losses is where we put in our taxable capital gain. Okay. Now you'll see the words there. We never put a capital loss into this framework. Never. It's only a taxable capital gain. If you end up in a capital loss situation, we're going to keep that capital loss and move it forward to the next year where we could maybe set it off our other capital gains. Okay, so you never ever put a capital loss into the framework. The only thing that you're going to do is you're going to take your taxable capital gain, which is going to be your capital gain, and in our next lecture I'm going to talk about inclusion rates. We're going to include it at a specific rate, and this is where it's going to go into the framework. Right. Obviously, there is a link for us in terms of what we've just been doing. Firstly, when we are in CGT, we are dealing with a capital asset. Okay, and we've just dealt with those capital assets. We've just dealt with what the deductions are that you can claim for those capital assets, right? It is capital in nature, right? What will also affect our capital gains tax calculation, when we go into the detail of the calculation, you're going to see that we need to know what the recoupment amount was in order for us to do the calculation. You're also going to need to know what all the allowances and the tax value are to do the calculation. Right, and then you also need to know if there was a scrapping loss that was claimed. Because if there was a scrapping loss, you cannot have a capital loss. If there wasn't a scrapping loss, you can have a capital loss. Okay, so these things are linked. They work together. And they are all dealing with the same transaction in any case. It is about us selling an asset. Okay, so why do we have this CGT thing in our Act? Why on earth did SARS bring it in? Well, it's not always been there. CGT was introduced, who knows when? 2001. Okay? 1 October 2001. Okay? That is when CGT came into our Act. Before that, you didn't get taxed on that extra part. Remember I said to you, CGT is when you're selling something above the original cost. Now, previously in South Africa, you just didn't get taxed on it. Okay, but CGT is something that's common around the world, and essentially what it is a wealth tax. So it's trying to tax the wealthy, right? Because when you are selling an asset at above its cost, it means you're sitting with an asset that has appreciated in value. Okay, so we're looking at something like, for example, some property that is increased in value, or a vehicle, a classic car that is increased in value. And the people that are holding those kinds of assets are our wealthy. Right, so it is classified as a wealth tax. We are not trying to tax the normal man or woman on the street. We are trying to tax those that have big assets and whose assets have appreciated in value above the original cost of the asset. Okay, that is what CGT is trying to do. Okay, so again, it's not trying to tax the ordinary man on the street. It's not trying to put an additional tax on it. It is meant to tax the wealthy. Okay, and it's trying to tax them because they've sold an asset for a very big profit. They've sold an asset for more than what they originally had paid for it. So SARS wants a portion of that as a wealth tax. And this wealth tax we call capital gains tax. Okay, I'm not sure the taxpayer is rich, but generally speaking, it is your wealthier people that will end up paying CGT. It is not meant to be a tax that affects everybody. Okay. Okay, so it's a wealth tax, and the reason is obviously to collect more revenue from the government's point of view and to obviously broaden their tax base, so have more places to collect tax from. And in terms of equity, collecting tax from the people who have more. Okay, so that is the reason behind CGT. Right, now what do we tax people on? Well, we know that we tax people on their assets, but which assets can SARS tax people on? Okay, so remember CGT kicks in when someone sells their asset. And it would kick in for a resident when they sell their worldwide assets. So if I'm a resident, if I own a property in Spain and I sell that property, CGT must be paid here in South Africa on that property. If I sell my property in Cape Town, there's CGT on it. Right, so for a resident is taxed on their worldwide assets. For a non-resident who owns property in South Africa, so we might have a UK-based resident who owns a property in Cape Town, they come here on holiday occasionally. When they sell that asset, there will be CGT in South Africa on that asset. So residents, worldwide assets, non-residents, any property that is specifically in South Africa. Okay, yes?
How will SARS know that I'm going to property in Spain? If I just sell it and I keep quiet.
Okay, so how would SARS know that I have a property in Spain? Because we're all honest, ethical people. I mean, we are, not everyone else necessarily, right? Okay, it's a good question. But property is one of those things that is pretty hard to hide. Because, you know, when property gets sold, there's all kinds of transfer things that happen. And yeah, with tax transparency and everything that's going on, our countries are sharing information with each other. So property, I would find it very hard for someone to hide away from SARS. And also remember, a taxpayer, I mean, if you own property in Spain, you probably have a lot of money. And you would then have to declare your assets and liability schedule. And again, ethically speaking, we'd hope you put it on there. But yeah, I guess you could try and hide it from SARS. But property is very hard to hide. So they would probably know. Yeah. Yeah.
So what happens if the country you sell your asset is a tax haven?
Okay, so if the country you sell your property in is a tax haven, okay, that would probably just mean that you're not paying tax in that country, right? But yeah, in South Africa, you're still going to pay tax. Okay, if it's not a tax haven, if there is tax there, we're going to have to go and look if there's double tax agreements. You know, there are other rules that would apply. But generally speaking, because you are a resident here, South Africa has the taxing rights. Okay, it depends very much on the double tax agreement. But if your property is in a tax haven, you're going to pay tax in South Africa if you sell that property. Okay, residents, worldwide assets, pays tax in South Africa.
Only in South African system if they've got proper systems to monitor.
I can see you're very worried about SARS monitoring this thing.
American system and South African system, American system is much more better. You will never play when it comes to tax and everything because the systems are automated with everything.
Okay.
But here, there's kind of a look sometimes before they realize, it takes time.
Yeah.
Yeah.
Okay, so I agree with you. It is not always possible for SARS to know exactly what is going on. And things do slip under the radar. I mean, let's face it, people try their luck and they try and keep things out of the system. But you must also remember that SARS is constantly trying to close loopholes and figure out where people are taking chances, which is why when I studied, the Income Tax Act was thin like this and now it's like this, because every time there's a loophole we just add an extra section to the act and we add in extra things. So I agree with you 100% that there will be places where, remember, I'm teaching you in a perfect world what the legislation is, how things should happen. We don't live in a perfect world. Systems aren't always good and things might slip under the radar. Okay, but we're constantly putting things in place to try and catch out those things. And we want to catch them out because the person who hides away their property, who doesn't pay their tax, means that you and I pay more tax. Right, so we want them to close those loopholes and make sure that the correct people are paying tax. Okay, so just an interesting one, because just from the feeling, your next question for me is going to be, how are we going to do it for a non-resident selling their property in South Africa? Because the non-resident sits in another country, how are we going to get the tax out of them? Okay, so one of the things that happens is when a non-resident owns property here, when they sell the property, by law, as that transfer happens, whoever's doing the transfer of that property has to hold back a percentage of the sale as CGT to pay over to SARS. Because SARS knows that when that UK resident goes and sits in the UK again, it's going to be very difficult for us to collect that money. So as part of the transferring system, as they're selling their property, SARS is, by using an agent, by using the people doing the transfer, holds back a percentage. It's a withholding tax. They're still going to try and claim the rest of the tax they need, but at least they've got something so long. Okay. So we don't live in a perfect world, but in a perfect world, this is what would happen, okay? And we just, like I say, I'm all for them closing the loopholes and figuring out where people are taking chances. Because essentially, when people are taking chances, they're stealing from us as well, right? So, yeah, that's what I say. We're the open, honest people, and we will, as tax practitioners, go out there and do the right thing. Okay, because other people are doing the wrong thing doesn't mean that we follow in their footsteps. Okay, definitely not. All right, now CGT is in the 8th schedule of our Act. So it's in a separate schedule of the Act, but there's one section in the Act that brings it into our framework, and that is section 26 cap A. And basically that section just says, go to the 8th schedule, figure out exactly how you're going to calculate your CGT, get to your taxable capital gain, and then you're going to include it into your framework just after assessed losses. Right, so that's all that that's saying. It's how it links what sits in the 8th schedule, where CGT is, how it pulls it into our Act. Right, and again, it is about pulling in a taxable capital gain. It doesn't speak at all about pulling in a capital loss. So capital losses are just things that we carry forward to the next year. Okay, 4 definitions that are going to be essential to us, and I'm going to chat more around these definitions in our next class, is firstly, there must be an asset. Okay, so what is an asset? Okay. Also then, we're going to talk about doing the calculation. Okay, so firstly, there must be a disposal. What is a disposal? Okay, so selling of an asset. But it's more than that, right? And then the calculation, our calculation for tax says proceeds minus base cost. Right, so we need to figure out what is proceeds in terms of CGT and what is our base cost in terms of CGT. Okay, so these are our 4 building blocks of CGT, and we will spend a little bit more time on them in our next class. Right, so there's the formula. Proceeds less base cost when we dispose of an asset. Okay, and it goes a little bit further than that, because proceeds, I just want to show you this so that you can see the link. The definition of proceeds is the selling price less the recoupment. Okay, so that links to the last part of our lecture we've just done. You need to know what the recoupment is so that you can work out the capital gains tax. Okay, and also here you can see you're not going to be taxed twice. You're not going to be taxed on the same profit twice. So that's why we are taking off the recoupment, because you've already been taxed on it. And our base cost, the formula for that, or the definition, is the cost price less our capital allowances or our scrapping allowances. So anything you've claimed on that asset, be it the actual allowances on the asset or a Section 11(0) scrapping allowance, you're going to deduct off at this point. Okay, and that will give us our capital gain. Right, ladies and gentlemen, I'm going to end there. That's all. I just wanted to make the link today. We'll speak more about CGT next time. Thanks for being here on a Saturday. I know it's a big sacrifice, but I've really enjoyed today's class and I hope you've learned a lot. And I will see you again on the 18th of May.